Good evening and welcome. This is our monthly meetup overview. My name is Roy Maddox, and I am the host of the meeting tonight, along with my partner and my son, Wesley Maddox. And we're both co-host and facilitators of the meeting tonight. This meeting is sponsored by Investors Business Daily. We are actually one of the largest meetup groups in the nation with close to 3,000 members. And people like yourself tune in every month to hear our comments and to share our thoughts and to communicate our views on the market. We intend on doing that tonight. I've been employing can slim tactics for 37 years, if you can really imagine that, over many different market cycles. By the way, before we get started, if you're not on our email list and would like to receive comments, Wes dropped a link, and be sure and sign up there. That way we can keep you informed when we make occasional comments about the market. A lot of those we think can be quite timely and can be quite useful in equipping you to make better investment decisions on a real-time basis. So we look forward to providing that with you. We believe with 100% certainty that people have the ability to change their lives by identifying and purchasing a few market leaders. We've done this over the years, many different times, over many different market cycles, and we'll be talking about some of those true market leaders tonight. The presentation is going to be very upbeat because the averages are on the cusp of breaking out to new highs. We have a plethora of stocks that we own personally and that we think are setting up for great buying opportunities and follow through if we get just a little bit of more economic news that's positive to just nudge this market uptrend just a little bit higher. But with the CPI news that's coming out tomorrow, we think that can be, in fact, the catalyst to get this next up leg going. So we're going to be excited about talking about that and sharing with you what we think is the current trend and what the ensuing trend and leg up will look like. Now, we don't believe in a buy and hope strategy. We believe that there are times that you should be 100% invested in the market. And of course, there are times when you should be out of the market. Certainly from 2000 to 2002, during that devastating bear market, it was appropriate to be out of the market the majority of that time. And subsequently, in the great financial crisis in 2007 to 2009, we had that same type of setup where the averages dropped over 50%. And when the averages drop 50%, many stocks drop 70, 80, 90% or more. And certainly your investment portfolio can't sustain that. So you can't have a 50% drawdown, particularly as you get older and you're retired. You just can't afford to have a 50% drawdown. So we don't believe that you should buy great stocks and that they'll all come back. In fact, most of the great market leaders from one cycle, they never come back. They never make new highs. Occasionally, you will have the same leaders that will come back and lead the next uptrend. But normally, you don't see that happen. So we're going to be pointing out a number of those intricacies of what's going on in the market that's important, that should be important to you right now. Now, we're going to cover many can slim concepts tonight, and we'll talk about some of the educational material that we're going to provide, and that's going to come from Market Surge as well as investors.com. We utilize many of the investment tools from investors.com, and we highly recommend you to utilize some of those tools too. They're very reasonable in terms of price, great resources, and we couldn't do what we think is important without doing that. Okay, tonight's agenda will be divided into two sections. In the first 20 the 30 minutes, I'll provide this overview. Wes will take over and take us through the slide deck. And really, after that, the most exciting part of the presentation will be when we're talking about individual stocks. And we think that we have a handful of stocks that we think that have the potential to double or triple from here over the next 12 months. So be sure and sit in that second half of the program where we'll talk probably about 100 stocks before the presentation is over. Now, if you're a novice investor, don't fret, don't worry. Many of the great investors of our time and in the past have had no formal experience in terms of financial theory, macroeconomic analysis, mathematics. A lot of those tools, really aren't necessary. What's necessary is a desire and a persistence and a commitment to learn and a passion in terms of what we do. When I met Bill O'Neill and David Ryan in 1988, that really changed my life forever. I knew that I was in the presence of greatness then, and I've continued to master this craft and get better and better and better and learn more and more and more over the last 3 decades. So it's that passion that we want to share with you tonight. So we think that's going to be important. Now, after completing a quite choppy first quarter and a challenging year in growth stocks, we began 2024 with a nice uptrend that turned into a pullback in our last meeting. That pullback is over, and we're knocking on the door of making new highs in the indexes. And so we're going to talk about incremental exposure. We're going to talk about, well, when should you reduce your exposure? When should you add to your exposure? You can see basically how we did it. And we think that will be a useful exercise for you in the future as you navigate and learn to navigate throughout the market cycles. Now, the market is currently in an uptrend. We're quite optimistic because the new highs, new lows, that indicator is expanding. The breadth is expanding. More and more stocks are participating. We're having more and more stocks to buy. And most importantly, the trend is positive. And we'll talk a little bit about the trend as we go as well. So we essentially have finished a 3-year bear market in growth, and you're starting to see small and mid caps start to outperform and participate. And that's really the last thing that we need. Is we need more and more participation for this market to really get turbocharged and go higher. But we think there are a lot of seasonal factors that are quite positive for us in terms of moving forward. So we think that's going to be important to look at. Okay, so this is a little bit about our group, 2,400 members. We will be talking about William O'Neill Concepts, and of course, he's the founder of Investors Business Daily. He died last year in I think it was 91. And so he's really changed a whole group of investors, their outlook and their methodology and their process because of the work that he's brought forth over the last 3 decades as well. Okay, disclaimer, of course, anything that we'll talk about today should not be relied on as investment guidance. You need to certainly talk to your own investment advisor before you make an investment decision on anything that we talk about here as well. And the same way, things that our members talk about that should not be construed as investment guidance either. So do your own research. Okay, this is the acronym CAN-SLIM. Most of you are familiar with this. It's in the book, How to Make Money in Stocks. And we really consider that the greatest stock market reference that's been written regarding market operations in the last 50 years. So we highly recommend you master those the techniques and tactics that we talk about and that are in the book, How to Make Money in Stocks. And we'll just ask you to go there for additional information on this acronym, but this is really screening criteria that William O'Neill came up with to identify the great winning stocks in the past so that we could take that information and identify the great winning stocks and the great market leaders of the future as well. We'll talk about technical analysis, fundamental analysis, and macroeconomic analysis tonight on a broad scale. And technical analysis, this is important. Wes is really quite adapted at this, as he is a chief market technician. Now he's got a CMT along with his CFA. And so he'll talk about these concepts with me quite often. But the indicators that we look at from a technical analysis picture might be things like moving average, convergence, divergence indicator, price phase, stochastics. But most importantly, we look at the trend. We are trend followers. And what does that mean? It means that if you're a trend follower, you have various metrics that you're looking at, and we look at and we identify the short-term trend and the intermediate-term trend and the long-term trend. We identify those based on various moving averages. We consider the market to be in a short-term uptrend when the 10-day exponential moving average is greater than the 21-day. We consider the market to be in an intermediate-term uptrend when the 21-day EMA is above the 50-day. And we also consider the market to be in a long-term trend where you should not have any exposure unless the market is above the 30-week moving average. And coming out off of a correction, we want to see 2 consecutive weeks above that 30-week moving average to be considered in a long-term uptrend. It will be very, very difficult to make money when you're in a short-term downtrend or an intermediate-term downtrend or a long-term downtrend. It's virtually impossible to make money when the trend is down. Now, happily, the market is just moving back to not a long-term uptrend, but it's moving back in phase where the short-term, the intermediate-term, and the long-term is all positive. And we're seeing more positive breadth and more stocks participate, which is very, very important. Wes will talk about some of these concepts, including the advanced decline line. He'll touch on new highs, new lows, and we think you'll find that information not just useful, but important to you. We'll look at some of the sentiment gauges in terms of is the market bullish or bearish based on sentiment? And we might consider looking at a few ratio analysis as well in terms of before the presentation's over. Okay, some additional information regarding CanSlim. Now, this formula has somewhat changed over the years. Remember when Bill O'Neill did the initial work, when he did his initial work, you didn't have really a lot of biotech companies back then. You didn't have as many IPOs back then that were profitable. And over the last 20 years since the book was written, the book was actually written, copyright, it was 1988. So it's been quite a few years where the market has changed since then. And in today's market environment, what's changed is that many stocks and many true market leaders, they can go up without having, without meeting that earnings bogey. And while Bill O'Neill never invested in stocks that did not have quarterly earnings and annual earnings that I'm aware of, now you have many stocks over the last 20 years that have gone up, like Amazon, Google, Netflix, many stocks that did not have earnings, but they had great revenue growth. And they had many of these other features and factors that were really important. So, this formula, look at this formula from a broad stroke perspective. And in just about every case, you're not going to be able to check off every box and for every stock that you look in, that you consider investing in. And there's quite a bit of art as well as science in terms of entries and exits and managing risk and identifying leaders and screening stocks. We'll talk about some of those things tonight. Macroeconomic analysis. Wes will do quite a bit of work on this tonight. And we use Hedge Eye Research, Keith McCullough, to just give us an overview from a macro perspective. It's the least important factor in terms of your process, but it's something that you should be aware of. It's important that you should be aware of things like GDP. You should be aware of market moving events like PPI today and the CPI tomorrow that in fact can be market moving in their nature. So it's important to be aware of those things. So Wes will talk about some inflation. He'll talk about some inflation concepts and also talk about maybe GDP and sort of where we are in the economic cycle. And another screen that basically shows and demonstrates that various industry groups they rotate and they're in favor based on what the economy is doing. If the economy is accelerating or decelerating, whether or not GDP is declining and inflation is going up or down and so forth. So we think all that is important. So with that, let me turn it over to Wes. And Wes is going to take us through the rest of the slide deck, and then we'll take a break and we'll come back and we'll talk about some individual stocks and talk about all the exciting equities that we think that are setting the table for the next leg up. So with that, let me turn it over to Wes. And Wes, you can take over now and I'll stop sharing.
All right, thank you. All right, so share. I added in one extra slide for you.
Okay.
So yeah, this is so we're gonna focus on GME and AMC and why you missed it and how to catch the next ones right here. This is Roaring Kitty's tweet that sent those, catapulted them to, not new heights, but double, triple in the last couple days. So I figured we should just at least touch on it just because I don't know, it's an interesting cultural phenomenon that this gamifying of the stock market. So anyways, if you guys aren't familiar, look into him. I'm assuming most of you guys are that are on this call, but this was the tweet that sparked the last couple of days of action. And so I want to update a couple of things we touched on last month and maybe even a couple of months ago, but we've been talking about how we're waiting for this pullback. You're trying to anticipate it as best you can and, rehearse how to handle it. And you think, okay, you could hold through a 6% pullback, right? And that's what we had in 2003, that first pullback to the 50-day, following a pretty terrible bear market. So that's why we're looking at this as an example. In 2009, similarly, you had that first leg up out of the bear market, and you get this 6% pullback to the 50-day. And so we're thinking, okay, maybe we just experienced that first pullback right here, just a regular garden variety pullback. Of course, in the moment, a lot of these things don't feel like garden variety pullbacks. But that's what, this is all you really need. You'll see it undercut the 50-day. That's what made a lot of this tricky with this pullback, because the indexes were never really extended very far above the 50. So that pullback was naturally, going to undercut the 50. which led to a lot of weakness and, a lot of weakness in individual stocks that looked like they could have held the 50 and then, felt the pressure with the index. So, it's possible that we just experienced it and we're kind of done with that initial pullback. Especially you see indexes at new highs. The NASDAQ at least is. The Qs aren't, the S&P isn't, the Russell's got a long way to go, but this is what we traffic in these kind of names, so this is good to see. You want to see this, and so it really does look like that pullback is done, but we'll see what tomorrow brings with CPI. And so I wanted to point out this too, why what you may have experienced in your account and why position sizing is so important as an example, and um, what these individual stocks are capable of. You have this NVIDIA, which is the clear, we think, leader in the bull market. The thing was up almost 100%, and then you get a 20% pullback, and that obviously is painful. And this is a aggressive bar, break below the 50. But leaders like this, snap back quickly. It retook its 50-day in 5 days, which we think is important for something like this. And we still view this as the institutional kind of favorite leader of this market. This is a key area that I think most people are watching, this 922 breakout. And so, we own some as it broke above the 50, being the first, we think, buy signal to nibble on this stock again. And this is definitely a widely watched breakout, but we also know that the 505 level here was a very highly watched breakout, and so that's not going to deter us. And I don't and don't think this will stop the stock just because there are eyes on this position. So this is something that we're watching carefully to see if it can break out, and hopefully it gives you a little bit of cushion going into earnings, because we know earnings for this stock are coming up next week. And then, equally kind of possibly painful is this FFTY showing you this 12% pullback. That during this period of time, number of stocks in that index are down more than that. And then you can see this, retook the 50. We have all these things that are showing, okay, the intermediate short-term trend is hopefully improving, and this is an important step in the right direction, just with the trend here kind of above the 50, the 10-day crossing over and all that happening in this IBD 50 growth subset of stocks. And I'll probably stop showing this after this month, but again, just for context, what we're looking at, just a normal pullback, we think that appears to be over. The average pullback being 16% in a typical year, but so far the S&P only being down actually 5.5%. So, relatively tame as far as that index goes. And just showing here, it's the 10th. It used to be up here, we had a very, very narrow pullbacks for the first 4 months. And then saw, a little bit of volatility there. And we wanted to include this. This is something a guy we follow, probably a lot of you follow, Ryan Dietrich. He shared this this sort of random breadth thrust indicator, being this S&P performance after 3 consecutive days of New York Stock Exchange advancers of 70% or greater. So kind of a funky number. Obviously, they wanted a couple more observations, but the point is, you see a couple of these instances where you see, broad improvement, I guess, and in just, broad basket of stocks. And we did just get that. And so, he's still in that bull, mentality. And I almost took this out too, honestly, just S&P performance around rate cuts. We've been talking about this, how, we think we're going to view rate cuts as good for the market. outside of a recession sort of leading to that, right? Or being the cause of rate cuts. But the more and more this goes on, the more you see inflation just sitting here at 3%, 3.5%, whatever it might be, the more you wonder, okay, well, let's put that conversation on the back burner for 3 to 6 months. But we'll see. Anyways, we're still looking at that. We're still considering it, but it's becoming less of an important thing. Clearly the market's shrugging off some somewhat hot inflation data that we got today. We'll talk about why that could have been hot or could not have been as hot as originally viewed. But still, just for context, this is some data we've looked at.
That's
I think
correct.
this is really interesting, and I promise this is the exact day highlighted right here. And with this red arrow, it really, this seasonality has been pretty good. Especially last year. It's been fine this year, but this is interesting just to see that it nailed the pullback and the rally back, and now we're sitting here close to all-time highs again. Perhaps ready to have this supportive seasonality ahead of the election that's coming up. So we're right here. It certainly looks like things get good for another year. So the 6 months leading into elections and the 6 months following that election historically, tend to be pretty good spans of time for the market. And on a macro level, this is kind of what I've been charting or whatever, looking at just to get a broad idea of how the economy is actually doing. And so I'm looking at this leading economic index that's published every month, and basically it's just it's it was extremely recessionary the last 2 years, and bottomed at some point in 2023. And for whatever reason, we didn't have that definition of a recession, but this is turning up, right? And so that's happened out of every other recessions. We bottom and things get better, and so that appears to be what the market's kind of is doing, right? It's front running an improving economy, even though we didn't have pretty good growth last year. This is telling you that it wasn't great under the surface, really. Okay, and so tomorrow again, CPI, it's coming out. What I have here is the forecast from the Fed of 3.5% year over year, 3.6%. That's in May, so that's the following report. But clearly we've stalled here. Okay, that's evident. But at the same time, the market's at all-time highs, and it's possible this is it's just moving to the back burner a little bit. Which we'd welcome, right? It's annoying having to worry about these month after month and really week after week, whether it's the PCE report, the CPI report, the jobs report, that are all looking at all these minute details of price changes. And so clearly we're stalling, though. We'll see what happens from here. And my gut reaction is to think, okay, and with the comp basically getting difficult, I still think that we maybe see some relief July, August, September in that data. So I would expect a lot of the same for the next 3 months, however, 3.5% or so. And I wanted to put in this since the PPI was reported. We've talked about this in the past too, how PPI leads the CPI. You can see how it led on the way up, it led on the way down, and now it's bouncing and accelerating. Right, it accelerated to 2.2% year over year. One of the things that was in the report, if you guys saw the number, it was up 0.5%. The problem with that, and that sounds really hot, and it was based on consensus, but we saw that the prior month was revised down quite a bit. So anyways, that 2.2% year over year number actually came out to about the same as you might have expected. Even though the month over month appeared at the surface to be pretty hot. But even so, like the NASDAQ closed at all-time highs, and we sort of got this hotter looking inflation data. So that's what it's a good thing, obviously, for the market to shrug that off and move to new highs like that. Now this is something I just wanted to highlight. I threw it in kind of last minute because I was looking at this guy, Jason Shapiro's report, who I follow and I've mentioned a couple times, and he was talking about just liquidity and how, we're shrugging off hot inflation news, and there's just apparently there's liquidity because that's what makes asset prices go up. And so you see this M2, this money supply number, which was, obviously massive in 2020 and with the money printing in 2021 with some of that too. And you're finally seeing that improvement. It actually bottomed in April of 2023, so just following those banking crises that we saw. And this is just about to inflect positive for the first time in, I guess, I don't know how long that is, a couple of years. So you would like to think if M2 is actually going to keep growing, that's just going to be more and more improvement in liquidity. We know that the Fed also, has pivoted to some extent, I think. I mean, obviously they pivoted to the pause, right? They're consistent with that pause outlook. But a couple things too are coming up in June. The balance sheet roll off is slowing down. So, that's a bit of a pivot, and I'm not sure, maybe effectively a cut, right? So they're going to shrink their balance sheet by a slower rate starting in June. And you can just you've heard in his comments more recently, he doesn't want an undue weakening of the labor market. So maybe he's willing to tolerate this somewhat higher for longer inflation, just to make sure he doesn't accidentally crush the economy. Because in fact, real wages are up, right? Wages are growing more than inflation now. And we still want to move things down, I assume, to 2%, but that can take some time as long as real wages are remaining strong. And so with all that information, right, all that inflation data that we keep getting, and that Fed rate cut keeps getting delayed, and so right now it's looking like maybe we get 2 or 3 or something still. That's what the market's still saying. We'll see. I don't think anything tomorrow is necessarily going to change that. If the market's going to go higher, I think it's going to be largely just ignoring inflation to some extent. So anyways, this is what we're pricing in right now, 5% by December. So we'll see how that evolves with more data. But to me, the 1 and 2 year, sure, they're important, right? Because they're just and they're implicitly including those cuts in these rates. But we're just going to keep looking at the 10-year. The 10-year is still going to be the accelerator or the brakes on the economy. And that, hopefully, right, as long as we're not talking about new highs in rates, this can oscillate and it can just do what it needs to do to work through inflation. But we think as long as this doesn't get unhinged, then ideally we work higher. And you can see that obviously the action in a lot of stocks has improved. It's not exactly widespread. The IWM, for instance, is still not quite at that 52-week high, and it's still treacherous, but certainly seeing improvement in some quality names. Anyways, so I'll go through now just the rest of what we typically look at, and this is the NASDAQ and MACD. We did get that buy signal in early May. That's nice to have it confirm this break above the 50 and this change in momentum. With that, good indications that things have started to improve. This is just a better look at the NASDAQ moving average crossovers, right? We always talk about the 10-day being above the 21-day, the 21 above the 50. And then all of them upward sloping. And so, we clearly, we broke, the short-term trend was down on this day for the indexes. And now, we've slowly improved and kind of melted up really to new highs in this index.
Wes, point out, if you will, the 2 faux follow-through days that got moved us off the sideline to a degree, because we went from being, 100% invested to 100% out to then incrementally getting back in. So show those two, those two
Yeah, I was looking for
follow
volume. I
through.
don't have the volume up
We
here,
don't,
but
yeah. And remember, we
I
didn't
believe it
have
was
the
this day
volume. We didn't have the volume
first. Yeah,
that actually confirmed, but we had the
yeah.
action in the, in the indexes.
Right. So actually, I can just drag. Why don't I just drag this over even? I can zoom it in. So yeah, we were, this. I think it must have been this day here.
Yeah, it
We
was.
were up. We were up 2%,
Yeah,
and you kind of were. We took a guess with 10 minutes left, right? You see the volume data, and you're up, 3-4% or something. You know, it was a follow through day, right? And then the data comes in at 4 o'clock and updates at 4:05, whatever. So that got us in, and it was, actually on somewhat lighter volume, but still a powerful day. And then I guess this day,
yeah.
this one was even up 1.5%. But I guess this was the actual follow through day. I'm having a. Do you
Yeah.
remember exactly which day it was now?
Yeah,
Do you remember?
both of those, we didn't get the volume that, that we
Yeah,
typically would use. But, the volume was not higher than the day before. The first day that you talked about, it
right.
was higher until it was
So 401. Yeah,
405,
yeah.
but they were both, the action was so powerful. The action was so powerful in individual stocks that was the tell to tell you that, okay, we don't have that official quote follow through day. Now you can see the market, you can see IBD say the market is now in an uptrend because we're at an all-time closing high on the NASDAQ. But you can see where those averages gave you they gave you a trend direction change. See where the 10-day crossed the 21-day. We're on the downside where we're getting, reducing exposure, and then we're adding exposure as price warrants. And so you can see there we've got the short term, and the short term 1, 2, 3, 4, 5, 6, 7, 2 weeks ago went to a buy. And so that was somewhat of a confirming indicator to tell you the market's getting better. And then you can see in the last couple of days, the 21-day crossed the 50-day, and which is again confirming and corroborating that the trend is, the trend is now in this uptrend. So both of these are highly unusual, but profitable setups. We think, and we do think tomorrow is going to be an important day. But this PPI came in today, it was a little bit quote high, but according to Wes's numbers, it really wasn't high when you look at when you're looking at the right criteria. Wes, go ahead.
Yeah. Okay. So yeah, we'll look at some breadth indicators. We talk about a decent amount. With that, correction, we had stocks above the S&P stocks above their 50-day come down, significantly, north of 80% down to 30%, and now we've rebounded. So, fine there. With the indexes making new highs, we do want to see more, even more participation and have that just continue. But that's where we are. Oh, why can't I? Whoops. Oh, sorry about that. Okay, and here's stocks above their 200-day. Not as much of it's obviously a much longer term indicator, and so not as much deterioration there. Um, oh, I know why. Okay, and then here's the NASDAQ in percent above the 50. It has been a little weaker as far, under the surface as far as this measure goes. But came in and, that's quite a washout. So, it shouldn't be shocking that it should not be shocking that this could be over, right? And so with indexes at new highs, this showing a pretty good washout, despite just being a 7% pullback.
Wes. I think Wes is having internet problems. Let me see.
This would tell you.
Wes, you were cutting out. I think Wes might be logging back on here. We'll see here just momentarily.
Hey Roy,
Yes.
this is Presh. While we're waiting for Wes, can I ask a question?
Yeah, sure. Go ahead. Yes.
Yeah, so I think something that you mentioned, I wanted to kind of pick on a little bit. So generally, are those your common signal when you see 10 crossover, 20 to in and out, or is that one of the criteria you use along with something else? And what was the, you know, uh, beyond this particular criteria, what other factor you consider to really get out 100% and get back in few days later?
Well, definitely the trend there, the trend. Wesley's trying to get back on here. Yeah, it's the trend. And that's just something that's something basically that I came up with in 2000 after experiencing that 2000 to 2002 bear market. I had to get something down in terms of hard rules to like get you out. How do you know, what tells you to definitively get out? And there are many different signals, topping signals like distribution that signal the market might be peaking. You could have distribution, you could have percentages above your moving averages and things like that. But definitively, I came up with that short term and intermediate term and long term. So, if we're below that moving average in the 30-week for 2 consecutive weeks, you can't be in at all. The rest of the time, the markets can give you, various opportunities to initiate positions, but we've found that when that short-term trend and intermediate-term trend is in a downtrend, it's going to be almost impossible to make money. So it's just something that I came up with 25 years ago, just to basically it was to prevent me from having another drawdown like I had in 2000 to 2002. I had to put something in to make sure that I don't have a 50% drawdown ever. And that's what I came up with way back then. And it's helped me navigate through all these bear markets since then. The bear market, I think I've gone through 8 bear markets, I believe. And so, and been able to survive every single one. And it's not fun, but if you survive, it sets you up for times like now where we're about to get very, very, very enthusiastic and very, very bullish if the market acts well from here. And by all of our metrics, we're right on the cusp of making that next new up leg, and we think that we're properly exposed as well. We got the right stocks. We think the market's turning here, and there's $8 trillion sitting in the sidelines that's going to want to come back to the equity market. So we think the good times are just about to really start. And, it's been a good year so far. We think it can be spectacular before it's over based on the seasonality and the secular trend that we're seeing.
I see. Thank you.
You're welcome. Wes, are you back on board?
I'm back. Lost the
Okay.
internet. Chris?
Yes.
Can I ask just a quick question? It ain't gonna
Sure,
take no more
Chris.
than
Yeah.
5 seconds.
just real quick. First of all, good evening. Secondly,
Good.
what I want to ask you, Roy, you've been in the stock market investing and trading for how many years now?
37 years.
37 years. Okay, in your 37 years, when you first started, most of the company was going long, meaning buying stocks and shorting. You had a lot of hedge funds and all the institutional long and short at that time, right? I presume. I don't know, but I presume.
There were, and not, the market wasn't as popular back then 35 years ago as it is today. But yeah, we've always had hedge funds and market operators over the
Okay.
decades. Yes.
Okay. The reason why I was asking that because it seemed like to me, I've been doing it. I've been investing in trading for 8 years now.
Yeah.
And it seemed like to me when I first started, it was more institutionals going long and short. But now it seems like a lot of institutions going long only. So
Yeah.
how do you see that? I don't know how to properly ask the
yeah, I
question,
think,
but how do you see that?
well, remember, Melville Capital, and these guys weren't any slouches. That's a spinoff from SAC Capital, Melville Capital. And those guys went broke the first time based on GameStop. They were short GameStop stock. And, they went broke, and these were real smart guys. And, but they just got caught in an untenable situation where you had some comments and people flood into the market and the shorts are getting squeezed and, market chicanery like that can happen. Most people don't, most people don't short anymore because of the GameStop and AMC type of scenarios. It's far too risky because you have unlimited downside when you short something that can go from 0 to unlimited to 1,000. And, you have unlimited risk on the short side for walking in and coming into a situation like GME. So today, I don't see as much shorting. I mean, you're going to have the algorithms and you're going to have the institutions that are constantly, moving around based on, the average daily range of the market. But individual shorting, they're a few and far between. But for that matter, Chris, those of us that are buying individual stocks, I mean, this is this is very, very rare. You don't find many people that specialize in buying individual stocks, but we do know that's how the real big money is made. The real big money is made, from people like Jeff Bezos and Microsoft and Gates and Amazon and Google and having these guys that are billionaires. Most of them acquired their wealth by having all their money in one stock. Tesla, for example, Elon Musk has all his money in the equity of the companies that he owns. And that's true. This is the true genius of building wealth. And that's in individual stocks, but you're not going to find, financial advisors for that matter, that specialize in individual stocks because they don't get compensated based on individual stocks. So they're, everyone else, 90% of the people out there are trying to put you in models that underperformed both the S&P and the NASDAQ, when the only way that you're going to that build big wealth and have a triple-digit year is concentrate in names like NVIDIA and some of these other companies that we've traded in the past, but have a concentrated position in an individual stock. But that's why we're here. I know after doing this 37 years that all the times that I've had a triple-digit year, most of it's because one or two stocks in the portfolio that I have 10 to 20% of my capital in, and it goes up, 100, 200, 300%, and that's how you make your year. And everything else is a wash. So by maneuvering in the market, by maneuvering around the market, you're trying to assess and judge and evaluate and adapt and identify those few companies that the institutions are going to pile in. And we look at, we think that the way to identify that is by looking at the volume, and particularly the volume as we go through various pivots, and we go through the volume as we go from from ranges to we break into new high territory. We want to be cognizant of the volume pressure in the institutional footprint that surrounds that type of action in individual stocks. So we do think that volume is important. We look at volume, and that can help you identify entry and exit points as well. So those are just some off the cuff comments.
And one more
Thanks
thing,
for the knowledge.
Ray, one more thing. I believe you briefly mentioned that there's money sitting on the sidelines, like $8 trillion or something. Where do we look up that information? Is there like a chart or something, like a Fred chart or something we can look up and keep up to date on that front?
You can actually, you can look at, Google money supply and look at the money supply numbers, M1, M2, M3, and you can, the Fed provides all that data and information. It is easily accessible. And I said 8 million. I don't know if it's 4 trillion, 6 trillion. It's a big number, it's a big number.
And you're talking money markets, right? I mean, that just instead of M2, because I mentioned, I showed that M2 thing earlier, and money markets would be, and a quick search shows, I don't know the source or if it's, how trustworthy it is, but it's like 6.4 trillion, which is up 21% from a year ago, according to this. It's, and that's a product of rates. And you can look at actually, so Fred does have that data too on a quarterly basis. If you want to look up money market.
Okay, and it's mainly M2 money, not the M1 M3.
Well, I'm saying the money markets, I guess, is what we're talking about with that, right? It's that assured 5% rate that, of course, is pretty attractive, especially during a bear market. And so, it takes a while for people to look at the market and feel FOMO or see, a better place to put assets, and then move that out of that 5% because, they're missing out on 10%, 20%, 50% in stocks. Anyways.
Gotcha. Thank you.
Yeah, that's my 2 cents. So you guys can see this still, right? The slides up there?
Yes.
Right. Okay. Okay, so I'll move on, through the rest of these, just a few more, maybe 10 more or something. And so, again, we always look at this, NASDAQ and net new highs, and you had pullback, you had net new lows here in red, and now we've seen that recovery with the indexes and, a slightly better market with the net new highs in the NASDAQ. And then just zooming out, we've got this longer term chart. And so, ideally we are here in this bull market run, but, net new highs, we're always looking for that, always monitoring to see, it's a good measure of market health. And here's the New York Stock Exchange with net new highs. This one actually, this looks better really than the NASDAQ. And so there's plenty of stocks out there that aren't in tech, and we'll talk about some other things too. The semis and AI has been a focal point for sure, and rightfully so, because a lot of those things have been up a lot. But this kind of says something like this kind of says that the bull market is everywhere. It's broad-based, and we need to, there are definitely some names. We'll talk about financials, housing, and maybe some others, just, as some ideas. Okay, and here's our overbought and oversold oscillator. We look at, we were overbought, pretty quickly off the lows there. So, any reading above this blue line is overbought. So we've been overbought for 1, 2, 3, 4, 5, let's not that one, but 6, like 6 out of 7 days. And we know that when that happened, of course, short term, everyone's kind of waiting for a pullback, waiting for a pullback. We haven't really got one. It was so far it's been a very, very tame, just sideways, low volume consolidation. Once we got above the 50, but short term it keeps you a little nervous, but long term, hopefully that means we get a few more months of decent action. And just to compare the recent past, we know when this happened and we stayed overbought November, December, we were able to propel forward for another few months. So hopefully that's what we're getting right here. And then here's the just other version. This is the NASDAQ McClellan oscillator. Similar idea. Short term, remain close to overbought. And we know that we're in new highs on the indexes down here too. Okay, we saw this VIX breakdown hard, right? And this will coincide with the index getting above the 50. The VIX similarly breaking down very, very hard through that as well. Again, a signal that stocks should be working better. And then here's a few sentiment things. We always look at this active management exposure index. And so this comes out weekly. I don't love that it's at 92% already. It means people got back in quick, it appears, based on this survey. We get more data every, like I said, already Thursday. Big jump there. It's been a good indicator as far as seeing when things are overbought, when it gets above 100. So, we continue to monitor that just to see if we need to, I don't know, slow things down at any point in time here. And similarly, sentiment from this AAII Bull Bear survey. We did have, a pretty sharp breakdown in bulls with that pullback, right? So as expected, and you had bears pick up with that pullback as expected. Again, you quickly had bears come down. It'd be nice to see bears be a little persistent, but it doesn't really matter if indexes are at all-time highs. You're not going to have very many bears. And bulls have been slower to come back. So, there is still some room, I guess, on this sentiment survey before we get exactly frothy on this measure. But again, always clearly, this is a warning to be heeded as it gets to be above 50, and the bears are historically low at that 20% level. So, keep an eye on these things. This is the net bull and net bear number here, just over a very, very long period of time. So we've, since the bull market, we think really started in November, we've had that kind of persistent net bull measure. So that's been, again, just been fine. Here's the put call ratio. So when puts are greater than calls, you're going to have a healthy amount of fear out there. And this is updated not as of today, but yesterday. It's a little slow, so you can see a big drop off actually in the put call ratio. So that's showing kind of a quick decline in fear with the indexes improving. Still have some ways to go to potentially get to complacent, but it's in a balanced area basically. And so you'll see that same thing here. This is the equity put call ratio. Just compared to the average over time, it's not signaling much here, I don't believe. And this is the high yield spreads. Man, this continues just to drift lower and lower, especially when you zoom out over the last couple of years. And so this high yield spread is a measure of credit risk in the economy, and it's sitting here at where it bottomed in 2021. So it really can't go much lower, I don't think. And it continues to show that I guess this is something that shows you there's ample liquidity out there, right? There's been no problem with high quality companies issuing debt and issuing bonds. So this is not raising any flags. And then just a couple more. We've got Bitcoin in here, continues to consolidate. It's not a perfect looking chart, of course, but it is something that we're real interested in, and we think going above 73,000, it's got a shot at being very strong. One of the takes I have on it is if this goes higher, you definitely get rid of, and it's making new highs. I'm sure you're going to be completely disregarding rate cut expectations, because I don't see how the Fed cuts when something like Bitcoin is making new highs. That's really a hard argument to imagine them making. So I don't know. I kind of look at this as an important asset too, from that angle, to think about what the Fed could possibly do. And we don't need cuts. We don't have, so that's why I'm just gonna kind of ignore that narrative almost for a while and just look at rates in general. And here's gold. We've been talking about this. It broke out here to new highs. This is a 15-year high right here, and it consolidated. Ugly reversal day. This signaled a short-term top for sure. Found some support, and really broke out of we call it the VCP, Minervini's VCP right here, just 4 days ago. So we own a little bit of that now, GLD on that day, and I think Minervini also bought it that day as well. And so that it did look like a classic kind of setup right there. And it's up. I mean, it's up 20% from the initial breakout still, but we zoom out, we see this, we see this is a decade and a half of consolidation for gold and making a new high. I mean, this thing shouldn't be done in 3 months. You look back at coming out of the 09 or 08 bear market too, you see this was a several year bull market in gold where it doubled or more than doubled. So anyways, a clear setup there. And it speaks to potentially the liquidity out there, despite fear of rate hikes kind of driving the market. And then last chart here, I threw in oil again. I think I talked about CPI and how the comps, right? So it's the comps get easier and in July, August, September. And part of the reason that's going to happen is because of oil. And so just thinking, okay, if oil stays at this level, you look backward and you see in August and especially September, you're going to see that comp, right? You're going to see that oil is down 20%, 20% year over year. That's going to flow through to the CPI number in August and September, and put some downward pressure on oil. It's a long way to get there. Obviously, that's like 4 or 5 months out. And so who knows where it's going to be, honestly. I don't think it's necessarily going to be higher than it was. But that's how I'm looking at oil. That's, I'm just considering it as how it flows through inflation, and that's basically it. But it'll oscillate. It looks, you look back 2 years, it looks pretty random, the gyrations. So, anyways, that's just an important commodity to watch. And that's all I have for these.
Okay, any questions? Guys, any questions so far? Okay, let's go ahead right here. Let's take a 5-minute break. Then we'll come back and we'll talk about individual stocks. So,
Hey, Roy.
yes, go ahead.
So regarding the indexes, they're going higher, but if you look at the volume signature for last couple of days, this entire rally is on low volume. The Nasdaq Composite, the chart that you have on the screen, I'm not sure if that is the right volume bar on the last day.
I think you're right. I don't think that's right.
But why did that happen? Because it's the same on stock charts too. it's, you know, 7 whatever billion or whatever that is, 72 million. I see the same number.
I mean, I have to look. I haven't had a
Yeah,
chance to actually to get to look at that, but that
yeah.
looks suspicious. But that's big volume
Okay.
today. You know, that's obviously huge today. If that is in fact, you know, good volume or not.
Right.
Right.
But absolutely, we were scratching our heads, you know,
So
looking at, you can see it on the NASDAQ, you can see it on the Qs, I think glaringly too, how low volume it is, and it's
Yeah,
right.
hard to
And
know what to really
assuming
make of
that
it.
last bar is not the right bar for now, the entire rally from the
yeah,
bottom
yeah.
is on a very low volume. Like it's not even average volume. It's
That's
really
right.
low volume.
Yep, and
And
that's
that is
why.
across the board.
Yeah, Yogesh, that's why it's important. We've actually, Justin Nielsen did a study from IBD, and they're actually about, I don't, a handful of episodes, and listen to me, where the market it's closed 5 consecutive days above the 20, we're speaking of the NASDAQ, 5 consecutive days above the 21-day EMA without a follow-through day. So I mean, you're talking about, you know, we're talking about just really looking at it really closely, but we didn't quote have that official follow-through day. And the reason that I've talked so much about the trend is that when all else fails, you got to have something when the volume's not there to get you back in. The trend's
Hey,
the trend is the only thing to get you back in when you say, when you're trying to sit on the sideline. And the trend is clearly telling you that we're in a market uptrend, and you should have fairly sizable exposure here because there are plenty of stocks to buy. Stocks are acting great, and and the market is in an uptrend. It's in a short term, intermediate term, long term, regardless of the volume. So you have to be quite careful, but the trend is what keeps you in and gets you back in. So that's what's got us in, despite us not
yeah.
seeing, despite having these, low summer-like days of low volume.
Right.
Yeah.
Okay, thank you.
You're welcome.
Yeah, and I mean, Patrick threw out the, you know, the GameStop and AMC volume, and I was thinking, okay, wow, maybe if, you know, if there were a billion shares of those things traded today or yesterday, but it didn't show up yesterday. You know, I didn't, right? Like if GME did 200 million shares, and if they did 200 million shares yesterday and today, you would have expected a spike in volume.
But
And both,
GME's New York. It's not NASDAQ either. Keep that in mind.
okay,
Both of those.
both of them are.
Yeah, both of those New York 3 letters.
Oh, is that what that means? I never knew that. Is that really?
Yeah.
Wow.
Yeah. Okay, so let's take a look. And so let's get into the individual stocks. So this is the most exciting part of the presentation because we want to make money and we want to identify a couple of these leaders and just as we walk you through the way that we're actually handling them, and you might can learn something from that as well. But let me pull up the NASDAQ one more time, and just like from a practical perspective, just to show you how portfolio managers do it in real life, is that you can see here, this is the NASDAQ, and of course we've identified these trends, and IBD's done quite a bit of work on this concept called power trend. So you can Google IBD and power trend to give you, and that's important to look at from a context perspective. But it is possible that we can go back in a power trend on Friday if the market follows through here. And that has nothing to do with the volume either. It's purely a trend following mechanism. that IBD's identified and we've used over the years as well. So we're right on the cusp of going into a new power trend. And the power trend, this is more like a temperature gauge. The reason the power trend is important is that's when you should be on margin. If that's why it's designed, that's what it was designed to do, is when you're in a power trend, that's when you should press the accelerator. And you should have been buying over the last couple of weeks as the market has improved. You should have been essentially out of the market because you got stopped out of most things. A month ago, as the market had that vertical violation of the 50-day and it went straight down. And that's what was so confusing, is that weekly break right there. And this weekly break is very unusual right there. That typically, when you get a break like that, particularly when you're near an all-time high, that suggests the markets can go lower. And it in fact did not happen. But that is why, that's why you have to respect what the market is telling you, because it certainly looked like you were going down there to that next line of support, which is the 200-day that's on this chart. And you can see that if you had the next move to the 40-week moving average or the 200-day moving average, that could have been quite that could have provided quite a drawdown if you in fact stayed invested and we didn't get any, and that wasn't a short-term bottom in the market. In retrospect, it was a short-term bottom, but you have to always practice defense first and then offense later. But that's basically the market environment that we just came through. And we had sold a lot of stocks up there when Nvidia peaked a couple of months ago, and bought a lot of those stocks back on the pullback. But we actually were stopped out during that 5-day move below all the averages when the power train ended. But then, rather than just shut your eyes and just turn the machine off, you have to stay alert and stay aware, because the market it's always only 3 days away from starting a new uptrend, 3 or 4 days from starting a new uptrend. And that in fact is what moved us off the sidelines. And how quickly you can move from the sidelines to get fully invested is a measure of how confident you are in terms of what you're seeing. And if you're, if you're hitting the ball, if you're seeing everything right. And we think we got it pretty right in terms of getting out and then immediately incrementally moving back in the market as the market has provided, this nascent upturn. Because if we're in a new uptrend here, we don't think it's going to be over in a month. Based on the information that Wesley shared with you earlier in terms of the seasonality, and we think the next year is going to be spectacular. And we think that we're going to get through this market, this economic environment without a recession. And then if the Fed is cutting rates and we don't have a recession, that's the most bullish market situation that we could experience. So we're very aware of the good things that might happen, and we're alert and wary, and we think that we think it's going to be, you can have a spectacular year from now towards this time next summer. So anyway, this is kind of what the overall look for the market. This is what the market looks like. We can do a screenshot. This is where we are right now. So you're going to know a lot of these stocks. You're going to know a lot of these companies. You can do a screenshot here. But this is where we're invested. And we bought all these stocks in the last 2 to 3 weeks. So we've gone from being zero invested to, I guess, maybe 90% invested in the last few weeks, and we're set up in these potential new leading stocks. So I'll take you through a few of these. Okay, here's CrowdStrike, and you can see CrowdStrike was in this nice uptrend. It is by far the leader in the security area. The action here is better than in Palo Alto Networks, Fortinet, Zscaler. This is the leader in the market. You can see where this stock peaked at 365, but then it broke the 50-day. And that's what I'm saying, is that a lot of these stocks that we had bought earlier, we got stopped out of all these stocks below the 50-day. And we started to add these stocks back in the last few days. We bought CrowdStrike back, I think 3 or 4 days ago, when it came back above the 50-day. And so we think highly of that stock. If you look at it on the monthly, which is more intriguing for us, you have this green light breakout, and you can see the stock was an IPO 4 or 5 years ago. You had that nice move, the correction, now the move back here to new highs. And we think the upside is wildly unappreciated by most market participants. So this is a $300 stock that can go to $600 in the next 12 months. So it's in a nice uptrend. This is exactly what you want. It's right off the highs. We actually bought gold, GLD, right? We bought this 4 or 5 days ago as the stock consolidated, broke out. And, this is a recent purchase for us in the last, week. And you can see the stock is broken into new high territory. That's an all-time high after going sideways for 20 years. And, we think this, this stock, the technical chart pattern is quite appealing. When you look at gold, this is one that we only have a 3% position in Bitcoin, and we're waiting for it to just improve just a little bit. You can see I have these horizontal trend lines drawn. These are pivot points, and these might be places where you might add. And you can see I have these alerts on our system here to show us when we hit these various pivot points. And these pivot points are places where you could average up. Like we bought maybe a 1 to 2%. We have a 3% position here, and we've put this on in the last 2 weeks after buying it, getting stopped out, buying it back. And we're going to, as we take out these levels, we're going to press it and average up, because this is something that we think, and this for Bitcoin, we think it certainly can go to 150,000 by the end of the year. It's, I think 65 or 66,000 is the 50-day. And if that happens, you're going to see this IBD, which is a Bitcoin trust, go from 40 to 80. So this is one where the upside is incalculable, because we have no idea when you have a market asset like this that has scarcity value, and with the halvening, what's going to happen there. But we think it's poised for much higher prices, and we're going to play it. We're going to average up. So taking out, if Bitcoin opens up above this 3670 area tomorrow, we're going to add to it. Then if when the stock takes out 3830 right there, we're going to add to it. And we're going to have a 10 to 15 to 20% position in our trading accounts when the stock takes out 42, because the big money is going to be made not here from 35 to 40, it's 40 to 80. That's where the big money is going to be made. So you're going to have to be concentrated. And so that's a measure of, you're going to have to consider your risk tolerance and what does that mean to you? Because a 5 or 10% position might be as much as you might be comfortable with, and I might be comfortable with a 20% position or so. but we've got high hopes for Bitcoin. We just bought this KD today at 27.30. You can see this stock reported its quarter 4 days ago. What got us interested in the stock is look at the revenues. Revenues 3.8, 4, 5, 7, 11. They're doing $15 billion in revenues, and the market cap's $6 billion. So it's got a price to sales, and I'm just sharing with you some of these intricacies. Price to sales of less than 1. And Wes and I were talking about this, and look at the numbers. Next year, earnings are going to be up 1,400% next year, and then 57% the following year. Remember, O'Neill and CanSlim, we're looking for earnings estimates of 25%. So here's a company that's estimating earnings are going to be at 1452. So, very, 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 very robust growth. And this also reminded us both of SMCI and VRT. When we identified those stocks, and no one were following those stocks. And this Kyndryl Holdings looks to be the same type of situation. So it was an IPO that's going to turn profitable. And so we see this stock getting to new high territory way up here and then seeing where the stock goes. But we think the runway is quite large there and long. Eli Lilly. Yeah, go ahead.
What size position would you have in these stocks on average? So something like this KD.
Okay, so that's a great question, Brad. And this was very, very thin as well. On a trading account, if you have a trading account, I would have 10%. We initiated a position with 2.5% today on this, and we're going to probably take it up to 5 tomorrow. But we want to keep, some cash on the sidelines for averaging up on IBIT. But you want to have a significant position so that if you get a double in one of these, it makes a material impact in your performance. So anything under than 10, like from a personal perspective, I wouldn't take apart I wouldn't participate unless I at least had a 10% position, in it. So it is extended, and the 10-day is, you can see the 10-day, the green line is 24.50. So it is quite possible if we had a negative CPI number tomorrow, this thing could open down 3 to the 10-day. So I see, we both see the potential downside there. That's why we weren't willing to go more than 2.5%. To give you an example of something that moved like this, that we took a little bigger position in, was TMDX. And this is going to be right below us. And this TMDX has a novel way of treating and specialized in organs transplants. And you can see this TMDX. We bought this on this 2-day pullback 4 days ago after reporting triple-digit earnings of 538% for the quarter. So what we liked about this is the stock was up 10% that day, and volume exploded that day. Volume was up 450%. And again, we talk about this in our Twitter feed occasionally, but anytime you have an explosion in volume where the stock is up 10% in price, and the volume is up 300% higher than normal than the 50-day. That's, for us, we're looking at that as a trigger and a buy signal, not a sell signal. We're not looking at shorting when you get that kind of action. That is the institutional footprint that you're looking for when a catalyst has just occurred, normally associated with an earnings release that powers the stocks ahead. So you can see when you had that powerful day, that 10-300 day, we've had this earnings drift, which is nice. And we have a 5% position here, but it's something that we'd like to have a 10% position everything. It's a matter of when you put it on and how you put it on.
Hey, Roy, what was the criteria you said? Can you repeat that again, please?
Pardon
Thank
me?
you.
What was your question?
Yeah, what was your criteria? You mentioned some criteria,
Oh,
10%.
the
I didn't follow.
10-300. And I screen this every single day. We actually have, if you take, let me see, are you seeing market surge right now on your screen?
Yes.
Okay, good. Just wanted to make sure. We have this screen here. See, 10% price, volumes up greater than 300%. And today, and I look at this every single day because it's what it's going to do. It's going to allow you to identify some of these stocks that don't hit your screens, the IBD screens. Like they might not hit the relative strength new high screen. They may not hit the EPS rank screen. And so some of these they're going to hit on this screen. And it's 10% in price, volume up 300%. And then you take a look at them. For today, GME hit that, HROW, ONON, which had a great report today. That's the shoe company. And what I have found is that many times when you get a day like this is your launch day. That's the day that identifies the stock as a potential leader to tell you should be buying it. So that's the shoe company. So if this stock comes in a little bit tomorrow and then takes out today's high, that would be a great place to add this particular stock. So that's
10% improvement in a day.
Pardon me?
You mean 10% appreciation in the price, the 300?
Yes, 10% in price. So, and a lot. So this stock was up 18% that day. So Wes and I are looking for these episodes that occur sporadically when you have this type of market action that's telling you, well, something truly unique. There's a just a flood of buyers there, so there's a stampede, and these stampedes happen. Many of the great winning stocks, you had a stampede, and these stampedes happen at the beginning of a run. For example, Amazon had this stampede. 10/27/2017, Google 4/22/05, Netflix January 28, 2010, Apple January 25th, 2012, Tesla 10/24/2019, Meta 7/25/2013. So we have a whole group of examples and many model groups, model book stocks that have this criteria, and we're looking for this criteria all the time.
Can I ask a follow-up? Question?
Yeah, go ahead.
Yeah, so this is actually great learning, at least for me. So when you do this, when it pops up 10% or higher and you initiate a position, I trust you continue to add and build up the position, as you say. What if it reverses back? Where do you stop, and what criteria do you use? Do you use the below, or you wait for the gap to fill? Can you educate us, please?
No, in this particular, in this one setup. Now, this is just one single setup. This is one single setup, and the art is knowing when they're going to sell, knowing when the institutions are going to sell into it versus when are they going to be forced into buying into it. And you normally don't see that it's going to take, you don't see that until you have the stock trade, at least the first 30 minutes. And you can look at some short-term charts like 5-minute and 10-minute bars to see if the move is real on an intraday basis or not. And that's called trading an opening range breakout. And that allows you to get into the position. But most of the time you should be buying it at the open. You should be buying it at the open and press it all the way up. Uh, the downside is you could be buying it and you can get whipsawed that day. And as you take the 10 or 15% position and you're averaging up, by the end of the day, you could actually be negative. So you have to add incrementally, but it should be totally green. If you buy that day, you want to be in the green by the end of the day. For you to feel like you have a legitimate shot at this being a verifiable setup. So keep that in mind. Okay, we're all familiar with, yeah, go ahead.
If I may, thanks. For these gap ups, what kind of stuff you use if you buy at the open versus buying at the close?
Normally the prior day low, or not the prior day low, is that normally the low that day. So, and there are a number of these setups, and you can see that normally they don't come in more than 2 days. So, they normally don't come in for 2 days. So normally if you buy it that day and it's going to work, you should use the low of that trading that day, the day that you get the 10-300. In other words, if like TMDX, see if you bought it with that 10-300, see where you should have used, there's your stop, the low of that day, the first day, and you never violated that. So that's great action. You don't want to see this ON. You don't want to see it take out today's low. That's your stop. So you normally use that low. Okay, go ahead.
I don't want to delay you if you have a lot of stuff to cover, but just one quick question. Have you by any chance had a chance to listen to the podcast where Mike Webster talks about volume not being what it used to be? He calls it dirty volume.
Well, you cut out on me. I really didn't get that.
Okay, can you hear me better now? Can you hear me?
I can hear you barely. I can hear you. I'll give it a whirl.
I'm sorry. I'll try to be as close to the mic. I'll be quick. Have you had a chance to listen to Mike Webster's podcast recently, where he seems to indicate that the volume is not as clean as it used to be? He calls it dirty volume. I don't know if you have any opinions about it.
I have, it's in my watch list. I mean, I think the world of Mike Webster, and I haven't listened to it yet, but we're gonna probably, Wes and I follow volume closely, so we think differently about especially volume with individual stocks. Now, regarding the volume on the indexes, that's open to debate, but as far as I'm concerned, it's not open to debate when you're looking at individual stocks.
Okay, thank you.
Okay, the next stock that we have is...
Hey, Roy, quick question. Just if you want to take an example, like something like TMDX or ONON, if you start with a 3.3% starting position, how would you pyramid up?
In a situation like this, if you bought what did it look like intraday? See, let's take a look intraday. So here's your intraday. There's the first opening range breakout, and you didn't have a clear. Normally what happens is you take out this is a 10-minute bar, use the first 30 minutes, and the signal to go in would be taking out this. On an intraday basis, would be taking out this high, this bar right there, that high. So you could see that there was quite a bit of volatility, that first 30 minutes. So if you had this position, you would have had, and so you wanted to have a 10% position, you'd probably have had a 3% position right here, around 35 or so. And then 36, you probably would have added a little bit more. And tomorrow you could probably fill out your position. Tomorrow, if it comes in, say to 35 and then takes out 37, or you could wait till you take out 37 and press it, right there. But you would do it incrementally. What you do not want to do is put your whole position on right there, in one stock. You want to average into it. And some setups like, and I mentioned this on SMCI that we mentioned because we were using this we were using the 10-minute bars that never gave us an entry point, but the 5-minute bar using an opening range breakout gave you the entry signal on SMCI when SMCI broke out after its earnings report.
And
Okay.
what if you end up only with a, say, if it doesn't allow you to buy more than 3 or 5%, would you then wait for it to pull back to like an 8-day or a 10-day and buy some more?
Yeah, you can use, most of these stocks that break out, they're going to hold the 10-day. The strongest stocks, like, for example, GEV. We've been watching this GEV, and you can see this GEV. This is a General Electric energy alternative company. They're in everything. And big company. You can see this stock, once it broke out, the green line is the 10-day. And we're not in this position, we're not in this stock, but we're looking about 8 days ago, we were trying to decide, do we buy it right here on this pullback? And the market was very questionable, 10 days ago. But now you can see that it came in here. We were looking for the stock to come into the 21-day. And then when we were going to buy it, it hit the 10-day today in reverse. So it just depends. All these stocks have different characteristics in terms of the way they trade. Some follow the 10-day, some follow the 50-day, some follow the 21-day. So you can, what's important is to look at the individual stock and see what it typically is trending. What averages or is it holding on? And those averages that they've held, where it's held in the past, that's where you should, typically where you should put the position on the pullbacks. But the stocks that break out the strongest, they only come back to like the 5 or 10-day. They don't necessarily, you don't want them to necessarily come back to the 21-day. The strongest stocks will only come back to the 10-day after they break out.
Hey, Roy.
Hey, Roy, can somebody put one
yeah.
individual on a mute? It's so staticky. I think somebody with the hand.
Israel is his name. Yeah.
There it was.
No, he was the one explaining. Sorry, it was Israel's got this background noise.
Okay.
Yeah.
Got him.
Thank you.
Okay, thank you. Appreciate it. Okay. Let's go to Lilly, because we've only gone through a few of these. Now Lilly is the consummate big stock here, and we own this stock. What we'll probably do is either press it tomorrow. You can see where it came in. The stock came in. It's right above the 50-day. So look at the volume explosion right here. So you can see it acted great. And Mounjaro is what Lilly, that's their weight loss drug. It's not Ozempic. Ozempic is NVO's, and Mounjaro is Lilly's, which is quite a bit bigger than Novo Nordisk, than their drug. And the benefits apparently are more impactful with Mounjaro than Ozempic as well. And you can see, but this is a big institutional stock, and we own this stock, and we sold this stock after an earnings report back here, right there, to make room for additional stocks. And we immediately felt remorse for selling it, because this was the first quarter that they released their Majerno results. And these results, this is going to make them billions of dollars. And we think after, with one quarter in the books, although there's going to be competition, VKTX is talking about an oral drug that has more efficacy, but that's going to take 2 to 3 years to be approved by the FDA. Novo Nordisk and Lilly are the way to play this, and this is a big macro play where we certainly see Lilly. We see this Lilly going from 800. You can see this. This is like a 4-month tight here. We see this stock going over $1,000 to $1,200 in the next 12 months. So it's a big company. You can see it it's turning here off the 50. If you didn't own it, you could buy a little bit here and then press it. Taking out 800, you can see the 795 800 area right there. Going into new high territory is where you would want to add to your position right there and press it up. And we certainly have that mindset and are planning on doing that when that occurs. So having the position on and being able to press it above 800, that's a great setup.
Hey, Roy, where did you pick up some shares of Lilly?
I think we bought it. The day that it reported.
Yeah.
Is that right, Wes?
Yes. Yes, it is.
Okay, we bought it back.
And why would you sell it after it undercut the low of that day?
Oh, we had a small position. We expected the stock to pull back, but it didn't trigger our stop. We had an 8% stop. It didn't trigger it, so that's why. And
thank you.
And by the way, this wasn't a 10-300. It was a day that acted great. It was an institutional stop, but you didn't have that 10-300 signature that I'm talking to you about. It was a classic pocket pivot where volume increased and breaking, coming off that 10 and 21 day. So you had that huge pocket pivot, which was a sign of institutional accumulation, but it wasn't one of these 10-300 days that we're talking about. So, and it's rare. The bigger the company, the more rare that it might be to have that 10-300 day as well. Microsoft is the next stock I wanted to touch base on. Let me see if we can pull it up here. And we just bought Microsoft like 3 days ago, breaking back over the 50-day. And that was the trigger for us anyway. So it's back, we bought it, taking out this 415 area in the last 3 or 4 days. And, Microsoft, we think Microsoft is the big winner. It's arguably one of the biggest winners in AI that's out there. And of course, they're in everything in the cloud, security, Azure, operating system, AI, they're in everything. And technically the stock becomes a buy, coming back, trading above the 50-day. So we added this. We think this is a $500 stock looking out by the end of the year. And so, that's certainly not out of the realm, thinking that this stock can go from 400 to 500 by the end of the year. And we think there's the setup there. If we think it's a quality setup, just like Eli Lilly. Nutanix is a company that a lot of people aren't aware of, that they're in that virtualization area. And we bought this stock, breaking this down trend line right there. So the stock, you can see this This is a double bottom, it undercut. And then you can see you had this, we call this an early cheat, where the 10 days crossing the 21 day and you're breaking this down trend line. And that happened right there. And we initiated the position right there only, 10 days ago. So this is a situation where we went from, not, getting kicked out of the stock, selling the stock, to buying it back, all in the course of, in the course of 2 weeks. So this is all of the stocks that we're talking about tonight, we put them on in the last 30 days. Because the next, it's not where they were when we bought them, but where are they going to? So this Nutanix, great numbers, great earnings growth, great revenue growth, institutional stock, great price of 67. And we think this is $100 stock looking out, looking out by the end of the year as well. Next stock, and of course, our biggest position, and we have, this is our biggest position. We added more NVIDIA today. In fact, I can pull it up here. Give me a second. NVDA. And now this is, guys, this is going to be interesting because this is the most followed stock in the market today. And you can see it's setting up, and everyone's watching this 920 pivot, and we'll probably buy more if the stock, and it's going to trade there probably tomorrow with a good, good CPI number. But everybody's watching this 920-22 area. You can see we have right here, we have an alert.
Roy, does that bother you that so many people are watching the stock?
Yeah,
There's so
it
many eyes
does.
on it.
Yeah, it does.
Yeah.
Yeah, it sure does. But the biggest win that we've had this year was right here when we actually bought NVIDIA right there first, and then we pressed it on that day. And our last fill was at 513, I think, that day. And everyone was watching this. See, look at this. NVIDIA went sideways for 5 months. And you had this beautiful VCP. You undercut, which was great. You undercut that area to clean up, all the buyers, all the sellers too. Then you had this nice VCP, and everyone was watching. But, nevertheless, you almost got a double in this stock from right there to right there. And so everybody's watching here. And everybody's watching 974. Now, earnings are 522. So I'm hopeful that we can get through this tomorrow. And, we have a great day. And you take out this 920. And, and we're close to this breakout by the time earnings are reported next Wednesday. And so if that's the case, you're going to have a really nice cushion. You're going to have a really nice cushion going into the number. But we were totally cleaned out that day right there. So we were totally out of the position because we didn't know if this stock's going to 600. You don't know where these stocks can go. When all is said and done. But that's why you have to respect, the technicals and respect, respect the drawdown. And, you got to have some kind of selling discipline because when you don't adhere to it, and then, this stock goes to the 200-day and you're down, 40%, then you can't make that up. But it's certainly, being down 8 to 10%, you can certainly make that up, but it's very difficult to make it up when you have a 30 to 40% drawdown. But there's the setup on NVIDIA. Everybody's waiting for that. So there's going to be it's going to be important. There's going to be some interest in taking this out to see the market, see if it squats, see if the institutions sell into it. It's going to be very interesting to see. Tomorrow's going to be very interesting to see. And then once we get through 974, but we studied a number of stocks like Qualcomm in 2000, Tesla. And we think that with the earnings power in NVIDIA, I mean, look at the earnings power. Earnings are going to be up next year, 85%. The following year, 26%. This is a stock that can double or triple from here, because as long as they continue to dominate the business, which they are going to do, AMD is a poor substitute. Everything's a poor substitute to what they're doing. And we think that, we think you could turn in, this could run a whole year from here, an entire year from here. But the numbers have to be good. And then you're going to have just more and more people that come into it. But I think that it's quite possible that we can get, for us to have the upside that we're talking about the second half of the year, that's not going to be possible without NVIDIA making its next leg. So we think the next leg is coming. And, if that doesn't happen, then it will mark its time, or maybe the market's not right, or maybe the stock's not right if it doesn't go into new high territory. But I certainly expect this to be trading at $1,000 this time next week, or next Wednesday, or by next Wednesday or Thursday. I would expect the stock to be $1,000. And if it's $1,000, I could get very aggressive on the long side, not just 15%. But you want to, you want to make those incremental, they're not all in one decisions where you're betting 100% of your position right then. You incrementally chip up in it, you little bit. And then when everything is going your way, like that power trend, if we go into that power trend on Friday, that's telling you, okay, now we're going to turn into it's about to turn into an easy dollar environment with the indexes at all-time highs. And Minervini's late. He's going to be late here. And I think he is late. He's buying some things now that he's been stopped out of. Not the quality that we're looking for, but we think, we think what we have is the creme that the institutions, want.
Hey, Roy, what if it forms a double top on earnings? If it again falls back after the 974, or if it goes higher and falls back.
It makes you rethink your analysis, right, Amit? Like you have to, you're gonna have, from every bullish, we don't want to just be bullish or bearish, but we want to, you want to trade the contingencies. So if this isn't trading at 1,000 next Wednesday, then more than likely I'm wrong. But if it's trading at 1,000, this market's going to be in gear and it's going to get hot. And the market participants, guys that aren't in, they're going to be chasing. They're going to be chasing. So it's a matter that the art is, getting back in over the last couple of weeks versus, how do you, what do you, if you don't have any exposure, how do you add exposure tomorrow if the market gaps up, 200 NASDAQ points?
Yeah, one of the things I noticed on NVIDIA, ARM, and SMCI, they're pretty violent in their trading. Yeah. I think it doesn't take any genius to figure it out, right? It's all algo. It's very violent. I mean, it goes up 10, 20 bucks, 30 bucks in a matter of 5 minutes. It's extremely violent.
And this is, ARM was one of our biggest winners. And Wes and I were talking about this. A mistake that Wes and I made on this were we only sold half of it. And then we sold half of it and we ended up getting stopped out. on the second half. Now we're in it at 65, but we sold half somewhere up in here, and then we sold the rest breaking the 50. And that is why when you're taking a look at this, now we were up over 100%. We bought this stock right there, and I think right there, I believe, see that cup and handle, and we did not sell it into this day. That big day. We thought, just looking at the numbers and AI, it was obviously very hot and in the news. We thought that this could have turned, that this should have been a $200 stock, and that's why we didn't sell it. And we ended up selling it, probably, in here, and then we sold the rest when when you had that violation. But it broke the 50-day, and let me clean this up a little bit. But these things were extremely violent, and we didn't have it. We owned the stock, but imagine riding this stock from 120 all the way down to 85. If you had the stock, and that's why we got kicked out. We gave it right there. We sold it. We gave it 2 days, and we didn't want this to happen. This waterfall plunge, where any of these stocks have the potential to do that. But you're right. This has had tremendous volatility, and now the stocks. This chart's broken. So the chart's broken. We're not looking at it. You have other stocks in the group like MU that look better, AVGO that look better, but NVIDIA is, of course, the leader. And you don't want to buy AMD. See, this AMD it's second tier. They're the big competition. They're not going to change anything. They're way, way behind. The difference between owning the number one stock and the number two stock, sometimes it's the difference between, making money or not making money. But normally there's a big discrepancy in terms of the performance.
Retiring and not retiring.
Could you take a look at Exxon AXON, please?
Yeah.
Seems to be doing very well when the market was weak, but now has weakened. And I was concerned if there is something sell that I'm not realizing.
The stock, you got, this basing action here. It's really basing. You can see where it had that great, nice move to earnings. And we were toying around with adding it, and we didn't. See, this is what happened in this last market cycle. And I'll show you a couple of these examples, but there are 4 different positions I want to continue to go over before I turn it over to you guys. But you can see this is what got your attention. See, the earnings and a fresh number. The stock broke out to new highs on good earnings and a good response. And so immediately that should get your attention. And, this stock came all the way back to the 50-day. And then, now it's violating the 50-day and sort of rolling over. But, the stock came into the 50-day. A lot of these stocks that we were in and that we rebought, they came in and then failed. This has the look of a stock that's failing. It needs to recapture that 50-day. The idea that it's, below it, and you got this volume expansion, this is glaring to me. You got to be careful here. And it's certainly set up for this undercut of 291. And a lot of times when you get these undercuts, that's the undercut and rally shakeout that turns into a shakeout +3. So it tried to go up to new highs, but they sold into it. And then there's your break. If I'm long this stock and I'm long this stock and I'm a swing trader, I would have exited that day, because the stock was down it was down $15, down 5% on much higher volume. And that's telling you the institutions are selling it right there. So it's getting through that right now. It's in no man's land. The 10 days below the 21 day. So it certainly needs to recapture this fast, but you don't know, because you don't know if it's going to bottom here or go to 250 or where it goes. But it's in a vulnerable position right now.
Thank you.
PSTG is one that we own, and you can see where we bought it. We tweeted this. We bought it this day. See where it broke the downtrend line that day? That was our early entry that we bought the stock right there. And so we bought this stock. You could have pressed it at 55.10 today, and we were having a little bit of a few issues with our platform, and we missed adding it during this pivot. See at 55.10, see where I've outlined that 55.10, where you add to it, and then you could add to it taking out 56.46. So there's your first buy. That's the early entry, buying the downtrend line. You can see that you have this two double bottoms. So in your typical double bottom, your buy point on your double bottom is taking out the midpoint of the chart on the double bottom. And see, that's why we have this pivot at 56.10. That's your official pivot, but your shakeout +3 would put it at 49.50, 51.52. 52 would have been an entry point, your shakeout +3 on it. So that's Pure Storage. So they're certainly in this, they're all involved in the AI area, and they're leaders in the flash-based storage area. You can see also WDC is strong in the group as well. And look at WDC, look at their numbers this year, 64%, up 600% next year. So this isn't, a stock that's going to have 600% earnings growth. It's typically not, that's next year. This is a stock that's going to take out these levels. If you get a stock that's going to trade these types of numbers next year, this stock is going to be in new high territory. So it's going to be way up here. And we don't own this. We have Pure Storage. We think, we like both of these, but we're in Pure Storage. But with this earnings gain of losing $1 this year to $7 next year, and this is going to be low. So institutions, the analysts haven't marked these numbers up yet. So this is going to be much higher. So this is definitely a beneficiary of AI.
Roy,
Peter,
real quick.
Yeah, go ahead.
When it comes to shakeout +3, do we always need to have a double bottom type of base to kind of do the +5% or something from the left leg low and upward? A different type of base would work, like a regular shakeout or a support line or something.
You don't. No, you don't. It doesn't have to always be a double bottom. In fact, it doesn't have to be, quote, a double bottom as is, but most of the time, many times, you're going to undercut some kind of level. And, it could be a flat base where you're breaking the bottom of the base, or it could be a double bottom, or it could be, a different type of symmetrical type of pattern, but it doesn't necessarily have to be a double bottom each time. But if you want to get sophisticated, I also use, instead of a shakeout +3, I use the point and figure chart. So for example, let me show you this. And looking at, we were just looking at Pure Storage. Let me show you this. So this is a little trick and tactic. PSTG. Here's PSTG. And you're seeing it on a different chart. And let me pull up the point and figure. Okay, point and figure. There's the undercut. Okay, so here's the undercut. And we can see we're in a column of O's right here. We're in a column of O's. And so the shakeout plus 3 would be 48, be 49, 50, 51, 52. Okay, in this particular case, when you get this move up, and I'm looking at the point and figure chart, when you go into a column of X's, that's when your shakeout plus 3 takes place. And you can look at this, you can consider this as a potential Darvas box, trading in a Darvas box here. And here's the day, there's the day that it went to a column of X's to give you your buy signal. So you got your buy signal and it traded at 52, and that was a shakeout from 49 plus 3, 52. And you simultaneously, it went to a column of X's. This is your buy signal using the shakeout plus 3, and I'm using point and figure. And the X's and O's are determined by the price of the stock. With the $100 stock, it's like 2% per X or O, and under a $20 stock, it's like 1X is like 0.5. It's like 1/2 of a box. So you just have to. You've got to just be aware of that. But you got your buy signal on the shakeout plus 3 confirmed by the point and figure. So you got the signal at 52 and the stock traded at 50, see 50, 65, and then it reversed the next day. But you had your buy signal on the point and figure entry point way back there using the point and figure, indicator. So this is a great tool to use when you're trying to guess the bottom. You wait for this point and figure to change. So that'll give you the directional change. And this point and figure has nothing to do with the volume. It only has to do with price when you're looking at point and figure charts. But that can give you some useful bits of information in terms of helping you get in and get out of a position.
Hey, Roy, can we quickly look at Micron, because that's a AI beneficiary with the high bandwidth memory.
Looks great.
So they have sold for whole of 2024, and their memory would also be used for Blackwell chips by NVIDIA.
Yeah, it looks great, Amit. I mean, it looks great. It would be, it's one of our favorite. Again, if you want our favorite in the group, chip stocks in the group, it would be, of course, NVIDIA. It'd be NVIDIA, Micron, or AVGO, or AVGO, Micron, Qualcomm could be there. Yeah, the action there in those 3. But yeah, MU, MU, look, ARM was one of our favorites, and of course it got obliterated. So now you're left with these. But yeah, this is one of our favorites. So you can see that this stock came in from 130%. See, and this is what made this so difficult is, look, this stock came in 25% in the course of only like 10 days, and everything came in. It was challenging on that pullback, and to get in that pullback and then re-enter. And you can see here, the stock moved higher 1, 2, 3, 4, 5, 6 days ago on volume. That was a big day right there. And it's firming up here. Institutions are buying it. Looks great. So this is one definitely. We think it looks great, and we think you can press it at 130.55, not sell it there, you know, this is going to go much higher. So look, speaking of the earnings projections, look at these earnings projections, Amit. Man, this is pretty amazing. From 42 cents this year. Now, do you guys think AI is over? If this company is going to earn 42 cents this year and $8 next year, do you think it's over? Heck no, it's not over. This is where you want to be in the next 12 months, right here. And now, if you want, if you want stocks with low beta and stocks that don't have the gas, there are, plenty of those to choose from. But we want to make as much money as conceivable that is possible based on the risk that we're willing to take. But we think that the runway here is quantifiable and it's extremely positive looking out. So this isn't a stock that's going to earn $8. This stock that's going to earn $8 next year isn't putting a top in at 130.50. That's not the top.
Exactly.
So I mean, it's easy to say this is going to be a $200 stock, in the next 12 months. Unless something fundamentally more and that markedly changes things. But right now, the action is telling you that it's one of the few semiconductor stocks that didn't even take out the 50 days. See, it came down, it got shaky, but then it settled down, set up, and now it's sitting there. It looks great.
Right, and yes, great list. Couple stock I don't see on your list. Wonder what your thoughts are. Kava and Celsius.
Okay, so we got kicked out. This, and I regret this. We sold, and we're trying to get back in Kava. So we had a 10% position in Kava.
Oh, you have regrets. I got in at 32, sold it at 36.
So, we sold it this day. We sold Kava this day. And the reason that we sold it was the second day below the 50-day. And we had this micron and stuff was blowing up around us. So you see where it broke 2 days below, and we were in it at 60. That's our cost. And we sold it at like 60, 58, 60, something like that. And we sold it right there because we were afraid of this. See where it traded, it was the second day, and then it came unglued. See, it broke the 50, stood there one day, and then no news, then it got obliterated. So we were afraid of a move like this on Kava, and we didn't buy it back. You can see we had this downtrend line, and we missed buying it back right there. There's your buyback day where you should have bought it back. And we haven't bought it back yet, but this has got it's a favorite. It's at new high territory. The stock is, it stock's going high. It has that characteristic that we're looking for. An IPO that corrected, then came back and made new highs, and it's on everybody's buy list. So the numbers are really good. They're solid. It's a cookie cutter story. People seem to like the food. They've got a great CEO. The CEO was the CEO of Panera Bread, I believe, and Albon, that restaurant, Albon, I think. And what's the name of that restaurant?
Alba Payne.
Okay.
Alba Payne.
Alba Payne. Okay. And anyway, people love it in the group. We didn't buy you should have bought it back. See where I have downtrend line. We're not in it. It's a leader, and we have a little bit of FOMO about not having that one, not buying it back. And what was the other one that you were talking about? Celsius. We can't. Celsius. We can't get a handle on this from the peak. This was the last earnings report where the report was great. It gapped down, then it made that move. Then they missed the last earnings report. You know, Jonah Lupton follows this stock, and we just can't make heads or tails. They missed. The quarter wasn't great, and it's just too. We can't stay on this bucking Bronco. It's too wild for us. You know, with the moves, you know, the ups, downs. So we just we've kind of suspended. It's on our do not trade list, really.
Yeah, I tend to agree with you on that. It is strange. I don't really, one thing with Celsius I don't understand is the ownership. Funds own 96%, theoretically, according to Market Surge. And the whole thing is just kind of strange with the shares in float versus shares outstanding. It seems like it's over-owned, but then it's also, I guess, a 10% holder that's liquidating because they passed away or something, and their trust is liquidating a 10% holding.
Yeah. I mean, you have it, but you've got a number of A+ rated funds. It's been very difficult to trade. We tried to trade this stock over the last year, and you can just see. I mean, look how wide and loose. Look at the times it vacillated above the 50-day and below the 50-day. I mean, do you want a stock like this? Do you want that? Or do you want this? You know, do you want that? Or do you want this? You know, do you want Celsius or do you want this? You want this. You know, you want this type of action anyway. Right.
Is this still your holding right now, VRT?
Roy, just IBD put out a notice yesterday that among the funds that did the most buying, they bought Celsius the most, even more than NVIDIA SM just 2 days ago.
Who did? What was the fund?
It's on the, you know, I can tell you. Anyway, it's, you know, where they have a list of funds, net fund buying.
Oh, yeah.
Fund selling.
On IBD, from IBD?
Yes.
Yeah.
And Celsius is one of the highest.
Well, look at it. I mean, look at it. You know, it's funny. It's a matter of perspective when you look at it. When you look at it, the chart. Let me see. Weekly. I mean, shoot. When you look at this thing on the weekly, it looks fine, right? Look at it. Look at it on the weekly. But, you know, look at this action here is so difficult, and I don't know, you know, it's, I don't know. The numbers have been good, but they missed, they didn't give great guidance. And we think that the majority of the growth that's in the stock, now, you know, the growth is slowing down. You can see this, you know, the numbers here, look. The last 2 quarters, 347 million to down from 384 to 355. It's going the wrong way. So, you know, the numbers are decelerating. I want those numbers to be constantly going up, not decelerating. So that's why it's just too hard for us to get a handle on it. And by that, it means we've traded it unsuccessfully a couple of times. That's what that means.
Thank you for explaining, Roy.
Okay, who else is showing up on your screens, guys? Because this is, you know, the stocks that are, this is the, you know, you're getting the environment that you want. I think it's, you know, we're about potentially to go parabolic here on some really good action led by NVIDIA, hopefully.
ADI and CLAC. ADI and CLAC. KLAC.
This is beautiful. This is a beautiful, beautiful setup. This is a buy right here. It's taking out 729. And this is picture perfect area. This is picture perfect where the stock was, in an uptrend, corrected. And again, like this, see, this isn't a double bottom. See where this is a flat base. But again, if you're using the point and figure, you would have had an entry point, here, as when the stock rebounded on that shakeout +3, and a shakeout +3 would have been probably $20. So, 640, you would have had your shakeout in 3 probably. And this, this is taking out, going into new high territory. It looks perfect. So in my view, and this is obviously from a disclaimer standpoint, everything we're talking about now, none of these are recommendations. We're not qualified to discuss that without knowing your situation. I'm just looking at the merit of the stock and the setup. This KLAC looks perfect to me. And what was the other one? Lamb Research, by the way, is in that group as well. KLAC is the one. KLAC, look at the difference. There's KLAC, Lamb Research, lagging. How about Applied?
The other one was ADI, Analog Devices. Thanks,
Okay,
Roy.
so this is in that group, this semiconductor group that is primarily involved in the industrial area. So ADI you've got ADI, which is in this unique group that's going into new highs. That's not, that's not necessarily associated with AI the way NVIDIA is. So, this is more of a suggests a cyclical upturn in the semi cycle. That's, that we've been discussing for some time. So, ADI looks great.
What do you say about the weak fundamentals, CLAC and ADI? Yeah.
What's that? The difference?
The weak fundamentals.
Well, the weak fundamentals in the group is because we've been in a semiconductor down cycle. So we're in a recovery cycle right now in semiconductors. This isn't the end. This is the beginning. This is the beginning of the next new super cycle in semis. I think you're going to see, Apple signed an agreement with, I think Chat, GBT, I believe, so that their AI platform is going to be going into the iPhone Chat GBT, and so we're in and what that's going to do is that's going to lead to a new cycle, an upgrade cycle in PCs, and so that's going to benefit Dell, Microsoft. So Dell's in that, Dell's in that data center service area, just like SMCI. You can see Dell is, looks great here. It's about to go into new high territory, 98 relative strength. And so that's definitely, poking its head up. Let me pull up a screen here, guys, just to give you a couple of ideas. So the market surge growth 250 screen. This is this is IBD's proprietary screen. It's made up of like over 25 different screens that Webster designed based on O'Neill's input. And this gives you an idea of like the leadership in the market and what's going on. Like this building maintenance group, you can see EME's there, Granite Construction, we own PWR, it's there. See, this is among the top couple of industry groups. Industry groups are really important. Normally the top 10 industry groups are going to provide the biggest bang for your buck. And this is constantly rotating. So you can see, I mentioned Sterling, infrastructure, granite, construction, PWR. This is a play on that Inflation Reduction Act. And, when the build out on the infrastructure, these are the companies that are going to lead, and they're showing up right here on your screens, and they're not technology. See, they're not technology. You're having mining companies like gold is breaking out. It's the seventh ranked group. So we happen to own GLD, in the area. You got shipping, which is starting to come on strong here. So we're taking a look at TNK and Starbulk carriers here. There's the retail, the restaurants have been one of the strongest groups. You can see the leaders: Kava, Texas Roadhouse, Shake Shack, Wingstop, Sweet Grain. You can see the leaders. So this will give you, you have a number of proprietary screens on IBD that if you know how to read them, you can find the nuances in terms of the rotation. And because you're constantly looking for that, like we're looking for the next leaders after this sell-off that we've just had. And so what we've seen is all the technology stocks and many of the AI stocks like ARM, they're busted. And now you have a few that are holding up, like we just mentioned, like a NVIDIA, AVGO, MU, and so forth. And then you can have a whole group of new names that might pop up from here: CRS, Steel Dynamics, STLD, NUE. And so you start looking in these industry groups, and you get clues to where the next leadership might come from. And nobody's heard of these names. Now, who knows who Core and Main are? What this company is. No one, unless you're in that industry group. Who knows who AZEK is? Not very many people, because people are following the Magnificent Seven. So you just have to be aware. Look at the biotechs. The group is 28. So look for, this is this is where these are the groups that are being populated right now. You've got some financial companies, IBKR, you've got American Express, you've got JP Morgan, you've got Schwab, they're all showing up. So you want to look at you want to observe what's worked in the past. So there's a chance that could work in the future, but you also want to be aware of rotation out of, these major groups to the next rotational groups that go into new high territory. So notice here, notice how few technology stocks we have here. So while we, Wes and I, and many of you are still on many of these technology stocks, the doors open for these companies like Badge Meter, BMI, so BMI, ITRI. This is where you should be focusing. These new names that you haven't heard about, but they're showing up based on you'll find them from their earnings reports, screening them, and they'll all be making, you'll want the ones that have high relative strength, with the relative strength lines going into a new high and the stocks going into new high. But many people aren't aware of, who's Itron, who's Badge Meter. Well, these are the next leaders. See, they just broke out, and these this is going to last not just 30 days, but 30 months potentially. So, that's what we're looking for. Okay, what happened? What happened with subtlety in the last 30 days in terms of rotational opportunities that are presenting themselves to you that we didn't have before. And see, notice all this time, 170, 1 to 140 for months, 125, for 10 months, this stock's made no progress. And then now it's game on. See, this stock never gave you never told you to definitively buy it. until the last 30 days. That told me to buy it right there. So now I'm looking for an opportunity to get in. So
Sterling Infrastructure is a similar one. Sterling Infrastructure.
Yeah, it looks, I mean, this looks fantastic. And, you know, new high territory only, you know, 4 or 5 days ago. Now we're playing PWR, and this is really thin. See, it's only trades 300,000 shares. Or we would, or, you know, Wes and I discussed buying this, but this is trading, you know, this is trading like $35 million a day versus PWR, which is in the same group, see number 4 group. This is trading, you know, almost 260 million a day in trading volume. This is why we, you know, the one that's got the best liquidity is normally the leader in the group. So, you know, GVA has really good action. So this is giving us confirmation the group's strong. But look at the volume here. This trades $20 million a day. I mean, you know, we would be, we'd be half the volume if we bought this tomorrow. And, you know, normally we want to limit our volume to no more than 3 to 5% of the average trading volume of the stock. But so this is telling you, great point. This is telling you STRL, GVA, Power, you know, these are strong group. You're getting confirmation. So additionally, what it means is that like for a typical CanSlim investor is that you have to get off the crack pipe. You know, it's, you know, if we can make, you know, if we can get the same kind of results and we don't have to take more risk and with a stock that's got a bigger average trading range, then, you know, I would prefer the less volatile than more volatile, you know, and it just so happens that the Magnificent Seven have, you know, led this market for a while, you know, for, you know, a number of years. So it's very difficult to get off those stocks and get on the, like, ascertain and, you know, look underneath the covers and see, you know, and truly see what's going on under the covers, the rotation.
Roy, at number 48, you have stock VITL, Vital Farms. Can you please share your opinion on that? VITL. I mean, if someone did not enter on earning, is it still a play, or it needs to be settled down, come down to 10-day line?
It's these are just real, very, very difficult. Well, first of all, it's in a defensive area, food, meat products. So this isn't really a growth area. This is really a recessionary type of, you know, you batten down the hatches, one of those plays. But the stock, you know, they have really good numbers. The stock, you know, made a new high, but you would not think that you would not necessarily think that this stock has in it the horsepower to really have a big move from here, but the stock is at all-time high territory and the numbers are really good. So it's just very difficult. You can see you have this ants indicator, see where the ants, the ants fired right back here, way back here at 20. And then the stock hasn't come in at all. And there's no pullback. It's just going straight up. Strongest relative strength. There's no flat base. There's no entry point. It hasn't given you an entry point until since there's your entry point right at 16. The breakout, and then you've had no entry point. I mean, you could have considered something like there, but it hasn't given you anything. So it's obviously it's very extended, a big winning stock, there's no pivot point, no base, but that's sometimes they do that, if you're lucky enough to get something like that, that can be impactful. See, this is another one that's doing that as well. That's got my attention. This is ZETA. And look at this ZETA. Look at the ants. See right here. $16 stock. The numbers are good. I don't know a lot about it. They're doing $1 billion in revenues. They're going to make money this year, next year. Never heard of it, but then look at the ants and look at the action and the earnings, see, that got you in. And look at that VITL when the ants hit here. Is right here. Right here. Is there. So that's sort of interesting. I mean, if I knew that, if I knew this stock was going to 32, I'd have my whole account in it, right?
Yeah.
But this is just kind of a provocative notion that I'm just throwing out that, some of these stocks are poking up like this and you've never heard of, I had never heard of Zeta Global Holdings before. But there it's popping up. But, I hadn't known much about.
I mean, like Elf Beauty was something similar kind of.
Yeah.
And then it became so explosive. So.
This was, Elf, and this is a David Ryan stock, right? I mean, David Ryan talked about it. So I thought it was over. I thought on this move here, from this move there to there, I thought the stock was over. And it's one of these that it got hammered, obviously, from 140 to 90, down 37%. I couldn't have ridden that down, taking a 37% drawdown, and then it came all the way back. But when you look at this on the weekly and the monthly, see, this was one of those this was one of the biggest winners, from breaking out there to there. And I thought it was over on this pullback here because it had moved from 30 to 130, up fourfold. And I missed the stock the whole move. And then you had the big correction and it happened to come all the way back. So it's interesting obviously it's interesting from an educational perspective, a learning perspective. Now you can see the stock's technically weak. Until it gets back above this downtrend line, it's no go for me. But breaking this downtrend line, look at that. That would be synonymous with breaking the 50-day, and that would give you an entry signal on it. So rather than guess here, we typically wait until you go through these pivots to initiate the position. It's not going to be the lowest price, but it's going to be the price where you have the highest probability that price is going to work and it's going to follow through. So you get through that pivot right there, and then, you're back on offense on Elf Beauty. Right now you're on clear defense below all the averages with the declining 50-day. Clearly you need to be on defense with this one right here.
We'll find out next week, Roy.
How about Uber, please?
Earnings coming.
Yeah, earnings 8 days. Yeah.
How about Uber?
What's the stock?
Uber.
Oh, yeah. So look, guys, this is, and I just to show you how pros get it right and pros get it wrong. And I've gotten a lot right and a lot wrong, in the last 37 years. You can be assured of that. And, I've had numbers of triple digit years, but I have had episodes too where I've got my head, chopped out off too. at various points in individual stocks, but this is what we found occurred in this last market cycle. Uber was one of our top positions, and we held Uber, and we ended up selling half during this market move up here. When Nvidia peaked, we ended up selling half, but we ended up buying for a lot of our positions, buying back on the pullback, like to the 50-day. And so we were buying, and then we got stopped out of like all these stocks that we bought, like they were leading stocks. We were up nicely in them. We sold half, and then we put the positions back on, and we got stopped. That we lost money on just about all these positions that we consider these, okay, these are the leaders. And coming back to the 50-day, the first time they should be bought, and it didn't work. And so you have a number of these stocks set up this way. And, Uber was one of our, the cash flow, the numbers, all that. We thought that, everything was great. And for whatever reason, the stock rolled over, and now it's, you're playing defense. But that's why it's so important to look at the trend. You should never buy a stock where the 10-day is below the 21-day. You can see where that 10-day crossed the 21-day way back here. So you should never own this stock in a downtrend. The stock is in a downtrend. Until the 10-day crosses the 21-day, this stock, on the upside, this stock is in a downtrend. And you had a number of stocks that did this. See, DraftKings did this. DraftKings was a leading stock, and then sold half, bought it back, and then got stopped out. That was the modus operandi of what was happening. It was a stock making a 52-week high, came back to the 50-day. You should buy stocks coming back to the 50-day after the breakout the first time, failed. And you could just go on and on. Oracle, come back to the 50-day. It should be bought right there, and it failed. And time and time again, this is what permeated the market environment. And what I'm sharing with you now is the market environment has changed. The market environment has been more forgiving. Oh, you've heard a lot about in the power area, and that NVT is a way of us playing that sort of. But this is,
I just wanted to ask Roy about this stock, and you just gave it. So I was going to ask about your opinion about it.
It's VST, Alex.
Vistra, right. I actually own it, and it has uptrend.
Yeah.
And it gave me very good returns. So
yeah, we want to. Yeah, it's a matter of now the stock. What do you do with the stock? There's no entry point. You got these ants. It's in a group that we think has got much upside. The plays in this group, and this is the wholesale sale of electricity. You need more power generation, right, for the build out in AI in the data centers and EVs. There's going to be a demand shortage, or not the demand shortage. There's going to be an explosion in demand in electricity. And VST, this is one way of playing it. The other ways of playing it are NRG. We're looking at NRG. Same kind of thing. See that nice uptrend. And then the other one, it would be CEG, which has they've got exposure in nuclear. So something's going on here. You can see, and this is clearly the build out. So we're looking, that VST, Alex, that you're talking about.
Yep.
We're thinking about how can we get into it. I mean, you can't buy the stock until it comes into the 21-day. And here it didn't even hit the 10. And that's why we were looking at the CEG. That's sort of, it's in that same alternative energy play, Alex, that you're mentioning. And this, this is, this stock looks, looks great as well. So these are the three ways of playing it. And now, all these data centers, they have heat cooling needs. And so the way, the companies that specialize in the dissipation of heat in data centers and all that are VRT, ANET, you got VRT, ANET, NVT that we have. You can't own them all, but this is the one that we're going with right now here. $80 stock, numbers are great. Not a lot of people know about it, and it's one of the first stocks in the last 10 days to come back and make new highs. So that VST looks great, Alex. Good job.
Yeah. The other question, Roy, how much run up has the VRT holdings? I mean, it did a spectacular job in the past year, but what is the upside potential for it?
Where can it go? This and we'll pull up ANET as well. We had a choice. We bought NVT versus VRT or ANET. Like those three stocks, we felt like they were very, very similar. And we bought them because we think we have more upside with NVT. But we own this VRT. We own this VRT last year. We got a big gain out of this VRT last year. It's just we sold it that day. And we sold it right there. And we've been in this, we identified this stock in the 20s last year. We got a double out of it. But this was an earnings move. And the stock was down like $15 pre-market. And I actually tweeted this day as well. So you can see where we sold it on this day. And we thought that we were lucky to get almost all of our money back out of the stock. And it was a shakeout. It didn't even, it blew through the 21-day, but then it blew through the 21-day, but then it immediately snapped back. That shows you how much you can leave on the table when you have just a little shakeout. There was no reason other than the market climate. There's no reason to sell this stock. When we had a profit in it. We booked the profit because it was down 15 and it came back. And so we took our gain and then we left a double on the table from there to there. So, we think that, things certainly like this KD has that type of upside and nobody knows about it.
Why did you sell the entire position, not only, let's say, 50% and hold the other 50% just in case it goes up as it did?
You're right. So, it's a little bit frustrating getting shaken out and again, not buying it back. See, we have forced ourselves to buy, we bought NVIDIA back. We're forcing ourselves, if the stock's set up, everything is not perfect all the time, and you have to adapt. And that's the art, trying to adapt. Well, what's the upside here? Do I buy back or not? Because that can be quite frustrating if you buy it back and you lose again. Most people don't go back to it, but O'Neill was famous for talking about if you got kicked out of a position and it reversed on you, you should don't feel bad about buying it back and buy it back at least 15% more than you initially had. That's, O'Neill was on record for saying that a number of times. It's just very, very, very difficult to do, to get out of your
Hey,
position and then buy it back 15% high, buy 15% more back. You gotta, you gotta have some depth to you to do that.
Hey, Roy, with VRT, what's happening is this is like their cooling and power systems for the data center. So
Yeah.
these are like external to the servers compared to
SMCI.
Yeah, SMCI has cooling technology within the server, and this one is external. So these people have a huge backlog because people are, let's say, if you are going to get Blackwell chips, 1,000 of those 6 months from now, they have like orders to get these, the whole racks and these things, so it's a long-term move. And I think you should also look at SMCI. I think there is
For sure.
Today it went up again, and it may again go back because SMCI has the benefit of the cooling technology in the server. So compared to Dell and HP.
Yep.
So who was asking, are you suggesting that SMCI has a better technology and edge in the cooling than Verity? Was it the point?
No, VRT is not a server company. They do cooling technology as well as power that goes in the data center. That's external to the servers.
I see.
And learn more.
So Amit, is it something like one or other required, not both? Like either product from SMCI or from VRT?
No, you would need both.
Both, okay.
Yeah, and a lot of these hyperscalers or data centers, they are also converting they have old systems, so they need more efficient systems in the data center. So the way people upgrade their servers, they also upgrade these power and cooling systems.
Yeah. Thank you, Amit.
Yeah. Roy, if you can go back to the SMCI, I think there is some good potential there with
There is,
NVIDIA.
So look, this, you see where I have the trend line, and I mean there's so many good looking stocks and good looking setups. Now this is different. This is a different setup. You can see the set, it's below the averages and so forth. But a break above this downtrend line suggests that this could go to $1,000 on the next run, setting up nicely. It's just I don't prefer. This has been quite volatile. And it's one of these that had it had this big move 400 to 1,200. Now it's coming in here. I just don't prefer this type of setup where you have the overhead. But this stock is setting up for the trade to take you breaking the downtrend line to go to the 50-day or over the 50-day, from 800 to 1,000. So there's a trade here. The question is, I'd rather have my money in VRT than SMCI. See, I think there's a bigger chance of this going from 100 to 120 than SMCI going from 800 to 1,000. So that's why I would prefer looking at, this VRT. So
where do you see potential entry points for VRT?
Pardon me?
Where do you see potential entry points for VRT?
There aren't any.
That's my problem with it. I'd love to be in it, but I'm not.
So, if you have, I don't have any, I don't have any FOMO, but if I had FOMO, you could buy this stock right here using today's low as a stop. But you almost had this 10,300 And this is what made it, if you go back and listen to the conference call to me wasn't that great. I mean, and they didn't blow it out. Look at the revenue numbers. This is VRT. Look at the revenue numbers. These are modest versus SMCI. The revenue numbers on SMCI were explosive. But this is when it reported. Let me see. This is the date and see. This is 4/24. Let me change this date to give you another handle on how you can see this, guys. For what was that date? 4/28. Did I say 4/28? Okay. No, this day 4/24. So no, this is a style we've been by, 4/24. Sorry, guys. 4/24. 4/24. Okay. So this is when they reported. Now, does this style look like a buy right here? No. This style looks like you should, this style, there's no way you'd touch it. It tried to give you that 10,300. So it was up big. This is when they reported big volume and they sold right into it. So, when you think about this, think about, okay, when did stocks top? When did stocks peak? They all have a signature look to them. This has the signature that the stock peaked like that day on the earnings report, and it should have been a sell right there. And it had this big move, 18 to almost 100. They sold into it. This is what like the Teladoc and Zoom and DocuSign top looked like, right? Just like that. And it got through it, change your date. And then you certainly didn't want to buy it that day. And then the next day it came all the way back. Look at that, up 6, came all the way back. And so if you didn't happen to buy it down right there, which would have looked like the top, you wouldn't have bought it the next day, but it came all the way back and it didn't give you an opportunity to get in. You don't have any kind of base. And that's what made this one, so difficult to trade. Came back to the 10-day, one day. And that's it. And, so there's that day. Came back to the 10-day, one day, and it's just sitting right here. If this style would get inside and just go sideways for 5 to 10 days and, use that pivot of 100, then that would have been a place could be a place to buy, but you need some kind of pivot, and that's no pivot. The last pivot was right there at 88.69. See right here. So you had this somewhat, this sloppy pivot where it got sold off, came back, and that's the setup there. So, but the quarter, I mean, look, they sequentially look at this is what got me on this one. Look at the revenue numbers. So for a stock supposedly right in the middle of this build out from data centers, and the revenue numbers, they're not exploding. They're actually going down from quarter to quarter. So that's what I did not like, is that the stock's growing and then the revenue numbers peak and go down, and they're turning down. So you've got to be careful with this because the numbers aren't as explosive as the way. Look at SMCI. Look at the revenue numbers on SMCI. They went, look, it went from 2.1 to 2.1 to 3.6 billion to 3.8. So this is a stock that the market was clearly unprepared for the $1 billion upgrades, $1 billion quarters, sequential numbers. So this had the big numbers, and so you had consequently that kind of blow off. But the numbers on VRT or ANET are just sort of mundane. I mean, the numbers here, the revenue numbers, this is supposed to be the number one stock in the build out of data centers. Well, how is the number one stock building out data centers? Why is it only growing sequentially? Barely, like less than 5%. This isn't telling me something's not right here. Either Wall Street's way behind on bringing the numbers up, or we're missing something here. But the numbers here aren't as explosive as the numbers that you had with SMCI. And
Hey,
so
Roy,
NVT.
ANET is just a networking play in the data center. So
What's that?
ANET is only a networking play in the data center. So even though their growth is pretty good,
Yeah,
compared to Cisco, like they kind of disrupted Cisco, but they only have certain amount of revenue compared to like NVIDIA and SMCI.
yeah,
But the other issue with ANET is NVIDIA is also building, they bought a company which has fiber network within the NVIDIA chips, or they are building their own servers too. So there is some competition with NVIDIA as well. So that's why it's not like a super growth, hyper growth.
Thank you, Amit.
There is a recent IPO, A Lab, I think ALAB is.
Yeah, this is an interesting stock, and this on our watch list. We're considering it. You can see where I have the alert. See right there.
It went down on earnings so much.
Yeah, so there I have an alert there, so it's putting this bottom in. Taking that peak out right there would suggest you could add the position. We're watching this. The numbers, I mean, you have what's nice about it, it's an IPO and it's brand new. So you have easy comparisons. So you can see it did 10 million sequentially, 10 million to 36 million to 50 million to 65 million. Revenue's up 270%. So let's say they do 70 million, this quarter, that's going to be compared to 10 million. So revenues are going to be up 700%. And, so you have easy comparisons for the next year on this one. So this is definitely, IPO definitely on our watch list. And there, right there is where you might want to add it, right? Taking that pivot out right there. And, you would add some there. You'd add more there. And, in terms of trying to position build in something, add here, add here, add here, all the way up, add a little bit, add a little bit, add a little bit. When if you're trying to position trade and not just take the, 10 to 15% trade. So, if you're truly swing trading this thing, you could have a 10% position here at 70 and sell it at 80, if you had that bounce like that. And, we're trying, primarily to use use swing trading for entry points to get in, and then, also exit, be more aggressive on the exit side. But we'd like for these swing trades to turn into position trades, because, the big money is going to be made when you have 10 or 15% in a NVIDIA and it doubles from here. So this is so fresh, so new, that this might be one of those stocks that you just can take out the high and double from right there over the next year. We're certainly looking for every different opportunity that presents itself in terms of skinning the cat. a lot of different ways of doing it, but there's your pivot point right there, that where this stock would be, quote, buyable right there, taking that pivot out, that high of yesterday. And if we have a good CPI number tomorrow, you're going to see it.
Hey,
What
Roy,
about
can you
GCT? GCT stock. This
Great
has some good
numbers.
result, but very volatile.
Yeah, great numbers. I mean, it's, you know, it forever. This was the #1 ranked stock in IBD in terms of the top 50. And it's got, you know, it's gotten quite volatile. The numbers are quite good. Look at the numbers. You know, really good numbers. You have an easy comparison. The company is located in Hong Kong. And so that gave me a little bit of pause because it's a Hong Kong company, but the numbers are quite good. And 99 relative strength, it's wide and loose. It's very difficult to trade, but it's on our screens.
Thank
Hey,
you.
Roy, how about a couple off the beaten path a little bit? How about RNA and Oscar Health?
Yeah, thank you, Charles. I'm very interested in Oscar and this RNA. This is a Minervini special. Minervini bought this yesterday, I think. And he likewise has been getting stopped out of a number of stocks. Like he got kicked out of STTK, lost money on that one today when that squatted, but he actually bought this RNA today, I think. But, you know, it doesn't have any revenue numbers. Look at the revenues. I mean, 2.3, 2.8, 2.2, 3.5. I mean, these are, I mean, they're doing $3 million a quarter, and we don't know when the drug is going to be approved, if it gets approved or anything like that. The action here is quite bullish, but it's just not a stock that we would buy because they're not making any money. They don't even have a product. So because of that, we'd stay away of that. Oscar is a different situation. I don't know anything about Oscar except it's in the last 4 to 5 days broke out. It's hit our screens. The numbers here next year are terrific. And look at the revenue numbers here from 1.4 to 2.1. Big numbers here, big numbers. Earnings are going to be good next year. $5 billion market cap. It trades about 60 million. So this Oscar something's going on with this Oscar. Looks good. 99 relative strength, blue dot special. Yes, so I would definitely I'd definitely spend some time. I'm looking at this stock as well. Why is the stock here? Sort of like that Zeta and the other one that we looked at that had the ants earlier. I forget who that was, but yeah, definitely a candidate here.
So if I have an oversized position primarily in calls, but also in shares, where would you see logical add points?
On a pullback, it would be on this time. You can see it's holding the 10-day. So the logical add would be a pull up, and it can be an abrupt pullback too. But an abrupt pullback to the 10-day, like a 2-day pullback to the 10-day to take your, to add to your position, and that would be, the 10 days at 20.50. So so this stock, say if this stock would be down $2.50 tomorrow, that would be a logical add point. Now you're going to feel like you should have stayed in bed, right? You're not going to want to, turn the machine on, but right there, it should be bought on the pullback to the 10-day. And it's, which gives me which gave this KD, gave me a little bit of pause because I'm keeping the door open for what if this stock comes back to the 10-day tomorrow, right here. Well, on this setup, I do want to buy it. I mean, It would be, I mean, I've seen this set up often where a stock pokes its head up and then they rug pull it, and then you freak out and you either sell it or you don't add to your position. And what we'd like to do, I'd love to see this 10-day continue to climb and have this settle down a little bit and add more to this, and not on the pullback to the 10-day, but you want this 10-day to continue to rise. And when it pulls back to a rising 10-day would be a time to add to this one. Now, if the market takes off here, you're not these add points that I'm talking about, they're not going to present themselves. So you have to be aware of that they're not going to be there. Now this MMYT reports tomorrow, by the way.
Hi,
Yes,
Roy.
sir.
What about SBSC?
This is really sloppy action that day. That's where it faked you out, made a new high on the earnings, and then they sold right into it. And here, this is relative strength is 58, which is poor. O'Neill found that, the true market winners, those stocks that can double and triple, but when they went back and studied them for the model books, they had an EPS and a relative strength of like 89 before they took off. That was what a lot of these had in common at the beginning of the move. So I really wouldn't touch a stock with the relative strength, under 90. I would avoid all those stocks because they're going to be laggers. That is telling you this stock is underperforming 60% of all stocks that are traded in the market, and 50%. And so I prefer to invest in the stocks that are outperforming 95% of all stocks in the market, the high relative strength stocks. So this would be slow, not great, nothing nothing great about the stock to want me to own it. Technically or really fundamentally. Earnings are going to be down 28% next year. I'd rather buy a stock that at least is forecast that earnings are going to be up 28% next year. So wouldn't fit our screens anyway.
Roy, can you take a look at Modine, MOD?
Yeah. So, in this air conditioning area, so this has been a hot area. It's a cyclical area. We're trying to get a handle on, do you buy, this Modine manufacturer? Nobody's heard of it. It's a cyclical company. But, the action is great. And we're trying to determine, do we want to own a home builder and a financial here? So we're very bullish on the home building sector in terms of the secular trend there when you go back and you look at it, particularly when you look at these cycles that home builders go through. And we think, we know that there's a supply shortage of home builders out there. If rates drop the way that we expect them to drop, you're going to see prices of houses again escalate, and that's going to support, the home builder sector and home builder stock. So, this group strong, you have a number of stocks in the group that are doing well. It's 25th. It's a boring stock where the stock looks great. Boring
These
stock.
people are more into industrial and not home segment.
Yeah.
And they are getting a parabolic move in the data center within the industrial space. So they are experiencing a big swing there. And on top, they have done some acquisitions to enhance that space further. So It's also same thing like a data center AI play. But if you look at the weekly chart, look at how much they have appreciated in 1 year.
Yes. Yeah. Yeah. So it's, it's the same thing that we're talking about, which is AI.
Mhm.
We think this is going to last for a while, and data centers are built out, so forth. This Carrier Global, see, this is in the group too. You can see this CARR, and this is why we're looking at, we're looking at all these names like this. So
Right.
heating, ventilating, air conditioning, it sounds like the perfect segue into the data centers. Does it not? So it's the same thing you're talking
Right.
about there.
There's
So-
another reason also, and that is the entire world temperature is rising very quickly. And if you look at the temperature across Asia over the last month and projected into the future for this summer, you will see that it's unbearable. It's all dark red. And so everyone is installing air conditioners and cooling systems in commercial offices. Which earlier in India, other places, they could deal with the heat. Now they can't.
Well, notice this. What is different about this stock is, this stock traded from 60 to 45 for almost a year, right? And something has just changed in the last 10 days. See? And we're talking, and we're really talking about the nuances here, but these are the nuances that you need to master and be aware of, so that you can ascertain, what do you do? What do you do? What action do you take? How do you assess your situation? You have to have some situational awareness, and there's your situational awareness. Something is going on. I don't know what's going on, but you just hear, we just heard some fundamental reasons, right? But what I do know is, man, something's changed in the last 10 days. You've got institutions that are buying this heavy. It's an air conditioning company that's typically growing at 5%. Is what's going on now? Something's going on in the prices, corroborating the move. So
I believe that everyone in the group, including Comfort, that's FIX, everyone went up and their PEs expanded. This was probably one of the laggards, and now it's raising this boat.
Yep.
I think institution needs to cool down buying this stock. They're too comfortable buying it. Pun intended.
Man, those are some great comments. Thank you, guys.
Roy, can you please bring up Powell, P-O-W-L?
Oh, yeah. Yeah, this is one of those that first poked out here. Look at this. So I had, so this was, there's your 10-300 day. And you did have, then you had this trade, and you had, that trade, and then you had this major pullback from 200 to 122, down 38%. And that's, again, that's sort of symptomatic of what the market went through. What I was telling you over the last 2 months is these stocks came back. See, they should have been bought. The first pullback to the 50-day after breaking out should be bought. And, I've practiced that tactic for decades. After a stock breaks out and makes a new high, on volume, and it's in a nice uptrend, the first pullback to the 50-day is normally viable. And there's your pullback to the 50-day. So if you bought it right back to the 50-day, you got kicked out of it, and you lost another 10% right there. And so this has come all the way back. You can see the cup and handle forming there, but the numbers are really good. They're in this infrastructure build out as well. So this is something that should be definitely monitored as well. But whatever happened here was, I mean, this was surprising that you had this 38% drop, but you had a lot of that, you know, in the pullback. So,
Roy,
you know, if you
can I share
weathered,
some observation?
yeah, I would. Yeah, go ahead. I'd love for you to go ahead.
Yeah. So one of the things, because this one, I all this comfort system and all this cooling system, right? All the industrial one like HVAC companies. I studied this one, and what I observed when they climb up this much and pull back, at the way just about all of this company pull back, historically they don't come back that quickly. It takes them months and sometimes years to come back. So when this pullback came and started violating, especially 50 days, I personally thought all of the stocks are pretty much over. But surprisingly, this time, only the time that I could observe in my study, that they really came back just like a tech stock.
Yeah. Yep.
So this is very unusual for all this industrial company to really come back, whether it's a Badger meter, something that makes a water meter or water filtration or HVAC components or whatever, right? This is very unusual for this industry to really come back. That actually, there is a positive about it, which is to say, maybe bringing jobs back to America thing and restarting this blue collar work that used to be outsourced for, you know, last couple 3 decades is coming back, and this is a longer cycle to really get started. Could be, I don't know, but this is my observation.
Well, it's because of the AI data center. They are getting a much higher demand right now, and also pricing power compared to a regular industrial manufacturing. A data center, you know, will have a different requirement and will pay substantially more. That's why their margins have jumped.
I see.
Yep.
Thank you.
Great input. Thank you, guys.
Yeah, Roy, would you mind to check NU move?
Yeah. Yeah, we looked at this earlier. It looks great.
Oh, sorry, I've already joined to
Yeah, looks at it great. Setting up. It's a leader. Looks great. Guys, I'm gonna give 3 more minutes, and I have I've got a knee that's acting up, so I need to get up and move around and exercise my knee. So I've got 3 more minutes left in me. So last call right here. Yeah, appreciate
Thank you for
tonight.
I just want to thank you for all your time and education. Appreciate it.
You're welcome.
Great session today. All the input from everyone.
Yep, this is the nuts and bolts. I mean, we're setting up. You just, you know, sometimes you need somebody just to point it out to you. And, you know, we get the follow through data more game on. It's going to get testy. You know, if the market sells off on a whatever number, it doesn't matter what the number is. What matters is the response. But man, we're sitting there where we're playing chicken between the longs and the shorts, the bulls and the bears. So one little nudge, a little nudge, and you're going to see, I think you're going to see a stampede potentially. And look at this 10-year, look at this 10-year, see the PPI, it initially went up and then the rates came down. And see, I think we're in, and Wes and I were talking about this, we're like, this is where we are. See where we had that break before, and then the move back up, a little bit move back up. And now we just need a move down. You get a move down like this on rates tomorrow. So that means you're going to be, I mean, you get a move here to the 5th. This is the, what is this? That's the 200-day, 43, 4.3. You get a move down here and it's going to be game on. And, you know, you get this in rates. You have a move like this over the next 3 or 4 months, and this stock market is going to be going straight up. So this is what we're watching. This is it's all you have to look for tomorrow is this to see if we get a move to here, you get a move here, you're going to see the market explode upwards tomorrow. And you'll see the narrative. It's going to change to not just one cut this year, but back to 2 to 3 cuts, because they'll think the Fed's is over, their job's done. So now it's going to get dicey if you take this high out and rates go up tomorrow. And I mean, you could have, you could have that next move up and rates come up here, and there'll be some pressure in the market if rates go the other way tomorrow. So, I mean, so hopefully I've crystallized it enough for you. And so to get you to help you think enthusiastically positive about the setup and what's happened with breadth, what's happened with sentiment, what's happened with the trend and the price. And then it's a matter of getting exposure, how quickly and how much, and where do you get in? And tomorrow might be your last opportunity if we take off and we're ready to go and take that next leg, because you saw where the presidential election cycle and all these look from a historical perspective. We have much further to go, and based on the momentum that we're seeing in the market, right now. So hopefully it's not, if it doesn't react, if we don't react positively tomorrow, we're just going to bide our time a little bit more. But there's an underlying bid in the market here, and you can clearly see that. And what I'd really like to see for confirmation, that power trend, you get that power trend, and that the earliest that could happen would be Friday. So I'll be writing about it this weekend if it happens. And that means to put the gas on. That's the time to put on margin if you're so inclined. And but the action has to pull you in. So it's been enough for us, I think, to pull us in, and we're keeping powder on the side because we think this Bitcoin is going to go next, but we have to incrementally add to it, so that's our view on everything. So guys, with that, let me call it a night. Thank you so much for attending tonight. It's our pleasure to do this. We love to talk about stocks. I mean, we kind of hem and haw here, but we're giving you some good tools and pointing out what we think are the leadership companies, and we're cutting your study time in half, or markedly changing the way that you're doing business. And again, if you'd like to contact us personally, feel free to do that. We do manage money on an individual basis for many people on the call tonight. And we thank you for being part of this community, and we're happy to serve you. So with that, good night, guys.
Good night.
Great meeting. Thank you so much.
Good night.
Thank you. Good night.
Thank you so much, Roy. Have a good night.
You're welcome, guys. Go get them. Great people. It's a great group. Smart.